You've got very sort of mixed signals coming from markets, active risks in various parts of the world, including the Middle East. These are all risks that investors have got to take on board right now.
This is both a international and domestic story, but also very much a DC in-market story.
The 10-year, the dollar, and oil are super critical. That macro trio is what's really going to dictate what happens going forward.
All this talk about rate cuts, and we remember the market does not care. The market has been concerned with earnings.
Ultimately, when the dust settles on 2024, we will still be talking about a situation where the U.S. economy is growing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get your week started. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Let's take the temperature of things in the Middle East. Crude lower by 1%. WTI 84.79 on Brent crude right now, down by almost 1 full percentage point at 89.63. An unprecedented direct attack on Israel over the weekend. Iran lighting up the sky on Saturday night, launching more than 300 drones and missiles. Nobody killed. Limited damage done in Israel. And Lisa, the word you hear over the weekend into Monday morning, one word: contained.
And de-escalation. And what types of efforts will there be to de-escalate on the part of the U.S., on the part of France, on the part of Germany? To me, the market isn't calm. To me, the market is not going to price in a geopolitical risk that has yet to transpire. But this is a market that is on edge with a new red line crossed. Iran has never before directly attacked Israel on its own soil. And even if it's not immediate retaliation, it raises the temperature in a new kind of way.
This, I think, is the consensus view on the street this morning. This from Citi. Iran's attack unlikely to lead to escalation in the near term. And I think we stress here the near term. Key actors seem to suggest that there is no desire to escalate the conflict any further, at least in the short term. Again, the near term, the short term.
It's the near term, which is why you see the oil market starting to recalibrate that risk we saw Friday before the attack going into it. Although you saw a lot of a big price premium building into the oil market. And then come Monday morning, you saw that Israel and its allies were able to strike down 99% of these more than 300 missiles and drones. But to Lisa's point, the biggest takeaway from this weekend is a recalibration of these red lines, completely erased in terms of direct response on Iranian soil to Israel. Now in the future, when you look at potentially what could be retaliation for any movements in the Middle East, this is now an option that Tehran may use.
And the president very focused, and you've talked about this a million times, Annmarie, seemingly on defense and not deterrence. The president came out before these events and said don't. They did. And we're trying to work out what that means going forward from here.
They said don't, they did, and now the president is telling Israel to recalibrate and slow down in terms of a response. But for Israel, and their work cabinet has yet to make a decision, and if they do, they probably will not tell the press out in the open. But for Israel, this is existential. Iranians send more than 300 drones and missiles, including ballistic missiles, directly to their airspace. At some point, Israel is going to have to respond. It's a matter of when.
There's a lot to talk about through this morning. I think the first thing you want to have a look at when you wake up is what's happening with markets. So here are the scores for you. Equity futures are just about positive by 0.5% on the S&P 500. The bond market releasing some of that haven bid from Friday, yields a little bit higher by 3 or 4 basis points, 455.84. And there it is, Bramo. Crude down by almost 1%, 84.85.
Crisis over. Everyone's calm. Everyone's not calm. This is really the key question as we get a slew of data, as we get Fed speak. How much do people have to start gaming out the idea of higher oil prices in a new kind of way? And it might not be imminent, but it is longer term. This week, there are 3 prongs. There's economic data, their earnings, and the Fed speak. Let's just get the Fed speak out of the way. We have Logan, Williams, Daly, Jefferson, Powell, Mester, Bowman, Bostic, and Goolsbee throughout the week. Curious to see how much they recalibrate, given the fact that we're seeing confidence coming in a little bit, but inflation expectations picking up. We're also going to get earnings. We have Goldman Sachs today, Morgan Stanley, and Bank of America tomorrow, and a smattering of tech later in the week, TSMC and Netflix. And then, of course, we do have economic data. We have the idea of retail sales that's coming out today. We have later in the week Beige Book and then jobless claims. And to me, the key question is going to be, how do you filter all of these types of events through the lens of the potential for higher commodity prices? To me, that's going to be a running theme underneath because of the geopolitical framing.
I think 3 things to watch this morning. 7:30, Lisa went through some of those issues for you. Goldman Sachs, those earnings coming out. Mike McKee catching up with President Williams. Look out for that conversation too, immediately after we get US retail sales. Coming up through the next hour or so, we'll catch up with former senior intelligence official Norman Rule following Iran's attack on Israel. Nadia Martin-Wigan of Svelland Capital on the response in commodities. And Andrew Balls of PIMCO saying US growth has hit its peak. We begin with our top story, Iran's first ever direct attack on Israel from Iranian soil. A war cabinet led by Israeli Prime Minister Benjamin Netanyahu is expected to decide on a response. The former senior intelligence official Norman Rule saying this: the US won't participate in a counterattack, but will insist Israel advises of the attack and that it will likely bring in US participation, if only for defence. Norman Rule joins us now for more. Norman, serious events over the weekend. I think we're all trying to work out whether this is a new phase for tension between Iran and Israel, or whether we just witnessed what some people might describe as a highly choreographed billion-dollar episode of skeet shooting. Which one is it?
It's a new Middle East. It's a Middle East in which Israel every day must wonder if some action might provoke an Iranian missile attack or drone attack on Israel's territory direct. And it also is a new Middle East in which Israel is now, in theory, open to do the same against Iran. The United States, Europe, the United Nations, and others will certainly not want this to happen. But by allowing Iran to conduct an unprecedented attack, which was certainly not just symbolic, you now have this new world.
The president reportedly, Norman, has told the leader of Israel to take the win. Take the win. What did you make of that?
Well, the president is correct in saying the Israelis have achieved an extraordinary victory over Iranians' arms and should pause and deal with the problem of Gaza, the challenge of Lebanon, before doing something that might escalate the region into a conventional war. All that's well and good, but again, if you're in the Israeli war cabinet, you have a serious issue. How do you deter Iran from doing this again? And that can't be put off too long, and that isn't something you do with a diplomatic note.
If the Israelis are looking at that, how to deter Iran from doing something like this again, what kind of a retaliation could we see, the scale of the retaliation Israel may take?
The Israeli retaliation will likely be proportional. It will likely be limited. It will likely be something that is meant to demonstrate we can touch you in ways that hurt. And for that reason, I think Israel is also not looking for a conventional war itself. But this takes time to work out. And I think what you're looking at is a cabinet in Israel looking for that Goldilocks a position, something that doesn't start a war, something that resets deterrence and allows them to focus on the issues that the Biden administration correctly addresses.
The Biden administration over the weekend went to pains to telegraph to the world that they do not want to see regional expansion of this conflict. They do not want to see a wider war with Iran. But what could the U.S. have done to then deter this attack instead of being in a position of purely defense?
Well, again, the White House is correct in doing what it can to contain a very fragile and turbulent situation. In theory, based on previous actions of the United States, it could have been a decision to move U.S. military assets closer to Iran, not because it's necessarily needed to conduct an attack, but to demonstrate to Iran that we might have been prepared to do something in that build-up period to deter an attack. But a lot of this also has to do with Iran's assessment of the U.S. willingness to engage in such a strike, whether Europe would join us. And I don't think the Iranians feel the Biden administration is seeking such a confrontation.
There were a lot of precedents set over the weekend, and it was really interesting to see not only that the U.S. backed Israel, but also the U.K., also Jordan and the other areas in the region that hate Iran more than they hate Israel. How does this set up the idea of what could potentially take place in terms of pressuring the region into some sort of peace agreement?
Well, there were a number of firsts this weekend, to include new weapons. Israel deployed its first naval Iron Dome. And you saw this unofficial coalition form of the United States, the United Kingdom, traditional partners, but also France, Jordan, and even Saudi Arabia. But this is a very ad hoc grouping, and it took a fair amount of diplomatic work. And I think we need to praise the Biden administration and particularly Central Command and NAVCENT for their work in building these partnerships. That's not always guaranteed in the future. And unless the administration believes the United States has their back, they won't be willing to enter into such formal entities.
Well, that's why I was going to push this forward to the idea of sort of freedom of the seas. You were talking about how we've seen the idea of trade really challenged. And then we're not even talking about the Straits of Hormuz and the fact that Iran went after a ship in that region and what this raises in terms of questions about the willingness to really curtail some of that transportation route. How much could this coalition go after to try to sort of reclaim some sort of freedom of the seas?
Such a coalition will not be effective unless it believes the United States is fully committed to deterring as well as defending aggression in the region. And the Red Sea example says that that's simply not the case. The United States and its partners have done a superb job defending and indeed degrading Houthi capacity. But there is no evidence that we're seeking to push this into Yemen in a way to deter Houthi decision-making. So unless you take that model and apply it across the region, if you're a member of the region, you're basically seeing that you're exposing yourself to retaliation by Iran and its proxies.
So Norman, let's finish there. What is the best way of influencing decision-making? What aren't we doing that we should be doing?
A multilateral approach involving economic and political isolation of Iran with patience and a willingness to take their tests of our fortitude has traditionally been the best approach. We just don't have such a coalition at present, and I don't see a lot of efforts to build one.
Norman Rule, thank you for your input this morning, sir. Always valuable. Former senior intelligence official Norman Rule. The president said don't. They did. Lisa, we've talked about this for a number of weeks, a number of months now. US and allies have struggled to prevent Houthi, Iranian-backed rebels from disrupting the Red Sea. It feels like over the last year or so, the ability to influence Iran has diminished. It hasn't grown.
And when we talk about additional sanctions, you have to wonder, have the sanctions that have been placed on it really had any effect whatsoever? There are all sorts of questions going forward in terms of how far Iran's going to push this, considering that they did cross previously was believed to be a red line. Right now, the focus has to be, to some degree, in this administration, prevent some sort of escalation that could cause oil prices to spike ahead of the election. That has to be somewhat on their minds.
Well, it's very difficult, though, for this administration ahead of a U.S. election, which is why they have a lax enforcement policy when it comes to Iranian sanctions that are on the books. And I think Norm got to that at the very end. It's economic coalition, meaning you have to pressure China to stop buying the more than 3 million barrels Iran is currently has in oil output a month. This is where it comes down to potentially that deterrence factor the U.S. could have been taking.
So far this morning, there is a belief that things are contained. We're looking at a bond market that's doing OK, yields are higher. Looking at a commodity market which is lower by 0.75% on Brent, 89.77. On WTI, we're negative by 0.8% at around about $85 a barrel. Let's get you an update on stories elsewhere. Let's get to your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. German Chancellor Olaf Scholz has begun his second visit to China. He's expected to say that Beijing has not acted on European warnings to end discriminatory business practices. Sources also say that Scholz wants to persuade Chinese President Xi Jinping to act as soon as possible to avoid EU tariffs meant to rebalance the trade relationship. Scholz is also expected to question Xi about China's support for Russia's war machine as the war in Ukraine continues. The Biden administration plans to award Samsung as much as $6.4 billion in grants to increase chip production in Texas. All of this is part of the U.S. efforts to really help domestic semiconductor manufacturing as it's grown in China and elsewhere in Asia. The money will also be used to expand Samsung's existing chip making facility in Austin. And the 128th Boston Marathon kicks off today. The city thinks that it will get a $200 million economic windfall, which would be the largest for it since the pandemic. 300,000 runners will be competing with a title and a $1.2 million prize at stake. That's your brief, John.
Danny, thank you. Best of luck to all the runners a little bit later on this morning. Up next on the program, earnings season ramping up.
If the Fed doesn't cut rates, you could have a little bit of pressure on valuations, but how do you offset that pressure? By higher top line growth and by higher earnings growth as well.
That conversation up next, live from New York City this morning. Good morning. Crude this morning, negative by 0.8%. A belief so far, at least in the short term, that things are contained. We're down 0.8 to 84.95 on WTI. Equity futures bouncing back by about 0.5% on the S&P 500, following the biggest weekly loss of the year so far. Under surveillance this morning, earnings season ramping up.
This is not just a one-engine economy, but sort of maybe several things working in favor. So that's why we look, of course, to the U.S. to have some of the highest earnings revisions momentum, but also Japan. That's why we look to industrials, materials, consumer discretionary, semiconductors, of course, to have some of that upwards earnings momentum. If the Fed doesn't cut rates, you could have a little bit of pressure on valuations, but how do you offset that pressure? By higher top line growth and by higher earnings growth as well.
Here's the latest this morning. Equity markets rebounding on the heels of a turbulent weekend in the Middle East as earnings season gets underway. And Witi Bahuguna of Northern Trust writing this. Earnings will support global equities, but potentially higher bond yields could weigh on already high valuations, underpinning our neutral stance within a multi-asset portfolio. And Witi, I'm pleased to say, is with us around the table here in New York. And Witi, good morning to you.
Morning.
See, there's a series of notes so far this morning. To what degree bonds are a challenge to valuations in the equity market? Can we just start there? Do you think we are moving back to that no landing scenario for both equities and bonds?
For equities, at least it seems like that, given how strong growth has been. But for bonds, it's still very much an inflation story. So if you look at what moved rates this year, that was a reasonably substantial move in the 10-year. But if you break it down onto what drove that move up, it was still predominantly growth being priced higher, and some backup in inflation expectations also. But it remains a growth story. As long as we don't see labor markets weaken, I think equities continue to do all right.
I've seen a lot of challenges to this rally. A lot of people don't like it right now. They haven't liked it for about 2 years, but they really don't like it right now. And it's potentially because they see earnings being unable to fulfill lofty expectations and the prospect of no rate cuts, the idea of higher yields in the face of higher commodity prices, et cetera. Are you on that same camp where you're kind of shifting to a more negative view just simply because of some of these overhangs?
Right. So, how long can, to Jonathan's question, the rate rise be digested by the equity markets? And I think as long as that growth momentum stays all right, markets will be okay with it. What's surprising, Lisa, is how it seems to digest any sort of geopolitical tension also. And that, I think, is really U.S. exceptionalism, right? Seems to be an island that's isolated from most of these events. Key for me is to watch what happens to oil and if oil stays contained, because that then seeps into inflation expectation, that then complicates the picture for the Fed, and then that makes you wonder, will any further rate hikes will be digested?
This is important. Is that basically a more important gauge to watch right now, even than some of the inflation data or the Fed rhetoric? It's really oil prices and how much they respond to the geopolitics.
Oil prices and labor market. Two sides of the spectrum on two tail risks that I'm watching. So the one tail risk is that labor market starts weakening. This enormous 400 or 500 basis points of tightening that we have seen over the last 2 years finally comes to bite the markets, and we see recession risks come into the forefront. And the other is oil. Inflation expectations seeps into broader CPI numbers, and then Fed's hands are tied. So two tail risks. But for the moment, we are staying the course, very neutral. Do not want to miss out on the strong equity momentum rally either. But at the same time, not a time to load up on duration either, because those are tail events.
When you look at oil, though, and say you park geopolitical risk, what does the supply and demand picture tell you? Because right now, the world does seem still pretty flush with enough supply.
There are lots of sanctions, and it's kind of hard to figure out who's breaking those sanctions and where the oil is going. But the demand picture is not a bad growth picture, because the demand picture means people want oil because economies are growing. Even the economies across the globe are looking for oil. So that's not really a negative if it's coming through the demand side. It becomes negative if it's through the supply disruptions and all the stuff that, again, markets seem to have digested that pretty reasonably well over the last 6 months also.
And your other concern, of course, the labor market. And you talk about immigration in your note. How do you prepare for, say, a 2025, 2026 labor market if immigration policy could be drastically different?
Yeah, that is a wild card. So far, the labor market has had a positive boost from the immigration supply. That's borne out in data, and that's kept wages contained. I mean, they're not contained, they're still around 4%. Fed would like to see that go lower, but so far that's been the support. And elections are potentially a wild card. We don't know what happens then, and that's not something you can prepare very well for again. So I go back to saying, stay the course, stay invested, do not panic on moments like this.
Staying the course appears to have changed from day to day, particularly with whether to go to bonds for risk mitigation characteristics or not. Can we talk about that just a little bit? Friday felt like that classic risk-off, earnings-led risk aversion with a layer of geopolitical risk going into the weekend, and treasuries rallied. But the relationship between stocks and bonds has been so inconsistent, as you know, over the last few weeks. What's your understanding of what bonds do for you in a multi-asset portfolio?
I think there's still a perfect hedge for a day like Friday. So you do want to have duration, but you don't want to be overweight duration at this point, Jonathan. So we are not overweight duration, we have duration, because if this geopolitical risk does become real, or for the first tail risk that I talked about, which was recession coming back into the forefront, you'll see treasuries give you enormous protection in a multi-asset portfolio.
It seems like a lot of people are saying they're hamstrung in this sort of aggressively neutral area. I think that was Sebastian Page who said he was aggressively neutral, and it feels like, there's sort of this trepidation of what you don't know. How do you hedge? What's the tail risk? Because you look at oil prices and say, if they cross $95, say, I'm sure you have your bogey, I'd love your take on that, then we need to have some aggressive protection.
I actually don't anchor on a single price number. It's really the compendium of all the data that we are looking at. And I love that expression, aggressively neutral, but I would say we are sort of like passively neutral, not very aggressively neutral, because, to us, a lot has been priced in terms of valuations in the equity markets. And really what I'm looking for is broadening of equity markets. And that, Lisa, we haven't seen. There have been sparks of it in March, but it hasn't really followed through across all the portfolios. So we haven't seen China rally massively. We haven't seen small cap value. It's still been a US large cap growth trade.
Well, small caps got absolutely battered last week, didn't they? And Witi, great to get your thoughts on the programme. Appreciate it. And Witi Bahuguna there of Northern Trust. Just getting some breaking news for you. It comes from Electrex. A report it's on Tesla that they will reduce the global headcount by more than 10%. Elon Musk cited as saying duplication of roles and job functions in certain areas as the reason for cuts. Again, this is based on reports. The stock is down by 0.5%. But if you take that 10% and you assume it applies company-wide, Lisa, we're talking about 14,000 employees.
Just a little more color here in terms of the email that was seen by Electric. This from Elon Musk. As we prepare the company for our next phase of growth, it is extremely important to look at every aspect of the company for cost reductions and increasing productivity. This sounds like a car company. This doesn't sound like a hyper-growth tech company. It sounds like a company that has been beset with a lot of questions around how many deliveries they can really make to China, given some of the low-cost options and given some of the geopolitical pressures.
Yeah, well said, Lisa. Without a doubt, right now, this is a company, Annmarie, confronting a really tough industry. And that industry is the auto market in general. And more narrowly, it's EVs, which have struggled over the last few months.
Absolutely. We're seeing this glut in the EV market a slowdown in terms of sales, especially for Tesla in a key market of China. And you're seeing this competition with Chinese rivals like BYD continues to cut prices. And Elon Musk, to Lisa's point, what he's saying here is cost reduction. They are trying to find ways to trim on the margins to make sure that they are profitable.
We'll look for some confirmation, of course, from Elon Musk himself or from the company Tesla. The stock is down by 0.5, call it 0.6% lower in the pre-market. Coming up on this programme, oil striking off tensions in the Middle East. We'll catch up with Nadia Martin-Wigan of Svelland Capital. She joins us very, very shortly. As you wake up this morning looking at crude lower by close to 1%, Brent down to 89.66, WTI Bramo 84.83.
Is this calm? I mean, this is what I woke up saying. Is this calm? Is this the market taking a deep sigh of relief? Or is this a market saying there's nothing we can trade on? So we have to just basically go with what we see, which is it's not escalating right now.
I'm not going to attempt to read the emotions of people as they wake up Monday morning, but I will say I think the big takeaway seems to be that it is contained for now, and we wait for one thing, which is to see what Israel's reaction to this is going to be, which is why we're all looking forward to catching up with John Kirby a little bit later this morning. That conversation about 2 hours away. Live from New York City this morning, good morning to you all as we kick off a brand new trading week. A little bit later, US retail sales. Live Live from New York City, welcome to the program. If you are just joining us, equities bouncing back just a touch, up by 0.4% on the S&P, on the Nasdaq 100 up by 0.5, coming off the back of the biggest weekly loss of the year so far. In fact, the biggest weekly loss, I believe, going back to the end of October. Small caps last week absolutely punished. The Russell up this morning by 0.2%. The relative outperformance of the Nasdaq 100, Lisa, the big cap tech story versus the small caps, pretty pronounced through last week.
And it just speaks to the haven trade and that somehow big tech is still considered the haven regardless of some of the rate concerns. Lori Calvasino put it really well of RBC Capital. She said geopolitical concerns are spiking at a time when stocks already seem due for a pullback. The rotation trade has just gotten a lot more complicated.
Let's get to the rate concerns. Let's turn to the bond market. 2-year, 10-year, 30-year, double-digit moves across the yield curve on a 2-year and a 10-year last week, and some new levels to talk about. New highs for the 2-year, 5% for the year. New highs for the year on a 10-year, 4.58. 86, and we're just short of them right now. We're up by 4 basis points on a 10-year, 456.66. And Lisa, the front end of the curve, 493 on a 2-year. And note after note this morning from Morgan Stanley and Mike Wilson to others as well, all talking about the same thing, the challenge to the equity market from these numbers right here.
And to take it a step further, all of these people talking about the fact that possibly we are looking at bonds not being the haven trade that they once were. And you ask us of Anwidi, and I'm glad that you did, this question of can we look at bonds in the same kind of way in a portfolio if we do see this potential inflationary shock underpinning an already significant concern about a commodity shock?
Is that why more and more people are starting to look at gold? Let's switch up the board and go to the commodity market. AMH, let's talk about crude. Down by 0.8 on Brent, 89.73. Down by 0.9 on WTI, 84.88.
This is because the immediate escalation, the immediate concerns of damage are now in the rearview mirror. You cannot say that the geopolitical risk has gone away, given the fact that Israel is likely going to be retaliating. But at the moment, it has all been contained. This was a barrage, a huge assault on Israel, and they will defend it off. And that is what you see in the oil market. Take a step back, a breather than what we saw on Friday.
So word you're going to hear a lot this morning, contained. Under surveillance this morning, Israel's war cabinet, led by Prime Minister Benjamin Netanyahu, expected to decide on a response to Iran's first ever direct attack on the country. A meeting of G7 leaders urging both sides to avoid further escalation. Iran launched hundreds of missiles and drones at Israel, yet nearly all were intercepted by the Iron Dome or allied forces. Now, Elisa, how long we'll be able to say that word contained, I don't know. And that's the risk around some of these stories.
Especially because, as we heard from Norm Rule, this has been a lot of unprecedented moments over the weekend. We saw the first time that we've used certain weapons, the first time that Iran has directly attacked Israel on its ground, but also the first time you've seen a coalition that has been pulled together from Middle East and as well as Western allies. Here's the key question. How does a market price something that is so ambiguous, that is so unknown? You don't, because you always get your face ripped off. So right now, it's hard to say that this market is really digesting what could be a potential huge geopolitical risk. It's just maybe there's a new risk premium that really sets a floor, as you've been saying, under the price.
I think the biggest takeaway from this weekend, and Lisa, you talked about it, is the red line has been evaporated. Glass has been broken. You cannot put that back together. Iran attacked Israel directly on their soil. This is something now we can potentially expect in the future.
Especially when the president is saying take the win. You know, some people might say this demands a response from Israel, but the president of the United States is saying take the win.
Well, this is going to be the scale that also Israel is debating. Individuals who say, like the President of the United States, slow down, take this win, look at the fortitude we showed, and then others like Itamar Ben-Gvir saying, in order to create deterrence in the Middle East, the landlord must go crazy. This is what we're dealing with right now in terms of how we decide and look at potentially how Israel's going to respond.
In just a moment, Nadia Martin-Wiggins is going to join us to talk about the commodity market. Look out for that conversation. I just want to shift gears briefly and talk about Apple. Continuing to face headwinds in China. iPhone shipments sliding 10% in the March quarter, according to market tracker IDC. This marks the steepest decline for Apple since COVID lockdowns back in 2022. Apple is facing growing competition from domestic producers like Huawei. The stock is down by 1.2%. On the session in the pre-market. Year to date, it's had a difficult year. We're still down by close to double digits.
It relates to the Tesla story, too, because both of them have a really significant domestic market in China. And it speaks to something that Peter Scheer of Academy Securities, who's coming up later in the show, has been talking about a lot, which is that China is increasingly a competitor, not necessarily just a supplier and part of the supply chain. They are looking to try to get their products out. And the key question for us is, how does a company like Apple diversify away from an area that is such a huge consumer base base, both with respect to buying, but also with producing said phones. This has been a perennial issue. And frankly, it's the same for Tesla.
Stock is down on Apple by a little more than 1%. Lisa mentioned Tesla just moments ago, a report coming out suggesting that Tesla is ready to cut 10% of its global workforce. More on that story a little bit later. Elsewhere, global metal markets reacting to new sanctions on Russian supplies. Aluminum surging as much as 9% before parent gains. The restrictions put in place by the US and UK late Friday are aimed at Russian metals, including nickel and copper. Meanwhile, crude markets are easing, expecting calm after Iran's attack on Israel. Joining us to discuss is Nadia Martin-Wigan of Svelland Capital saying, quote, to assume the war is now over is premature, so we would not be sellers of oil at $90 a barrel. Nadia joins us right now. Nadia, let's talk about it. So potentially a new floor for crude. Let's talk about how high that ceiling might be. How high is that ceiling now?
Well, it's great to join the show. I think immediately we saw that on Friday, we traded up to $92 a barrel before the close, before coming down. That's a first target. We know that there is a lot of call option length at around $95 a barrel. So that's the next question, is whether we meet that price in the coming weeks before expiry.
Nadia, can we talk about the potential for retaliation from Israel? There is a sense this morning, and I stress in the near term, we keep hearing this word around this table, contained. How contained do you think things actually are, and how do you think this commodity market would respond if we began to see headlines suggesting that Israel is ready to retaliate?
Thus far, we would characterize market reaction as pricing in the Goldilocks scenario, that things are contained, as you say. We believe that if things were to occur in terms of more tangibles, that Israel would, how a counterattack would come, or if we saw additional attacks on the shipping industry, right? There is no indication that the Houthis are stepping back. And as early as last week, there were discussions that maybe we would reach a permanent ceasefire. Right now, that doesn't seem to be the case. So any sort of attack within, especially the Straits of Hormuz, that would absolutely impact the oil market and the shipping markets immediately.
Nadia, if we were going to see, and I know Congress and the House of Representatives, they want to see this, a stricter, at least the Republicans, a stricter enforcement on Iranian barrels. How much enforcement would actually take some of that crude off the market?
Yeah, so we've seen that since 2019, Iran's crude exports have risen from around 500,000 barrels per day to 1.6 million barrels per day, because the U.S. is largely turning a blind eye. So that's at least 1.1 million barrels of oil that could come off the market and could be supplied instead by Saudi Arabia. And we're still in the same supply-demand balance as before. That would also impact the shadow fleet, because it would mean that actually crude would have to be transported by the ships that are VLCCs and so forth that are involved in the normal market. So that would lead to a price appreciation on the shipping side as well.
When you look at potentially a place for OPEC to step in, a lot can happen between now and June 1st when the group is set to meet. At what price point do you think they'd be willing to add more supply?
Well, in the mid-90s, upper 90s, they would absolutely be forced to. They don't want to see $100 oil, according to themselves in recent interviews. So then they would really be compelled to step in. And that's where, when we see those tightening balances, we didn't see balances build or inventories build in the first quarter. The IEA reported last week that we are at a 5-year low in terms of OECD company stocks as of the end of February. There's going to be a lot of pressure on them to increase production when refiners come out of maintenance. And in China, that comes in June. In Europe, that comes in June. So that really coincides with that OPEC meeting to provide more crude to the market so refiners can run as they should to meet demand in the second half of the year, that we see much higher than what the IEA put out on Friday at 1.2 million barrels per day year-on-year growth. We think it's closer to 2 million barrels per day year-on-year growth, and that includes some growth in U.S. oil demand.
Just can you give us a sense of how much potential ammunition the United States has to counter some of this with the Strategic Petroleum Reserve, given the fact that I'm looking at oil prices about the highest going back, gasoline prices, I should say, gasoline prices in the United States highest going back to October, heading into the busiest driving season, heading into an election where gas prices sometimes win it or lose it?
Yeah, in our view, it's premature for a U.S. SPR release. Probably they would release 500,000 barrels per day starting 4 months before the election, 1 million barrels per day 2 months before the election. So they really want to hold that ability to easily throw in as much market oil as is necessary to the market until they actually see a supply outage in the Middle East, or until we are much closer to the election, because we're still so many months away that they don't want to use up that bullet before we're close to the election.
Now, going back to something that you said at the very outset, that we're pricing in Goldilocks, is there any risk premium baked into the price as is that you can identify that wouldn't be there, where prices would be substantially lower if there wasn't this pressure coming from the Middle East?
Well, there is some priced in, right? We've seen the net length in the oil market rise quite a lot. And in the gasoline market, it's, at a 4-year high. So there's definitely some priced in. On the other hand, we have a bullish view going into the rest of the year. So it makes a situation difficult to say that, okay, maybe people are putting on this trade a little bit earlier because they see the demand is coming. But right now there's a heightened risk. So some have floated $5 risk premium. That's maybe possible, but we would really have to see a permanent ceasefire come out of this in order to see, I think, prices really trade down. And then the other one to include in this is, of course, the situation in Russia. We see up to 1.3 million barrels per day of refinery capacity being impacted by the fact that these Ukrainian drones have, had 12 successful strikes on refineries. So, we can't forget that right now the market is assuming that everything will be up and running perfectly by mid-April to mid-May. But what if that takes longer because Western companies aren't involved in refinery maintenance in Russia? So that is another element that all is not at ease there. So that's an additional element of political risk that I think is a little bit underappreciated right now because the focus is on the Middle East, but that risk still exists.
Some big assumptions out there, really well framed. Nadia, we appreciate it. Nadia Martin-Wigan then of Svelland Capital. Crude this morning down by 0.75% on Brent, 89.78. Just a quick correction, aluminium. I know my British friends will reached out. Do you know how much stick I got?
You got a correction for
aluminium.
That? Really?
Aluminium. Are we done? I hope we are.
Really?
Aluminum.
Aluminium.
How about this? You say aluminum, I say aluminium. We'll cut the whole thing off.
There we go. Let's do that. Let's give an update on stories elsewhere. Let's get to your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Donald Trump is set to become the first former U.S. president to face a criminal trial. Trump is facing charges that he falsified records to hide hush money payments to a porn star in order to keep voters in the dark. Jury selection begins today, and Trump is required to be in court every day. He has pled not guilty, though the charges don't bar him from becoming president. If convicted, he faces as many as 4 years behind bars. Singapore's prime minister is set to step down May 15th after 2 decades. It's a planned succession. Deputy Prime Minister Lawrence Wong will become the city-state's 4th premier the same day. And Scottie Scheffler has claimed his second green jacket in only his 5th start at Augusta. He's the 4th youngest golfer to win multiple Masters. Scheffler won by just 4 strokes with a 4-under 68 in the final round. For Tiger Woods' part, his score was his worst ever. That's your Bloomberg brief. John.
Hey, Danny. Thank you. Congratulations to Scotty. Fantastic 4 days at Augusta National. Just getting a match here from Tesla. From our reporters, Ed Ludlow and Dana Hull, Tesla to cut over 10% of the workforce. More on that story a little bit later this morning. That stock is negative by 0.75%. Up next on the programme, Fed officials urging patience.
I don't see urgency, and I see lots of reasons for patience. And over the longer term, I think my expectation is that we will ease, and that over the longer term, inflation, interest rates will be at lower levels.
That conversation up next. We'll catch up with Andrew Balls of PIMCO. That conversation just around the corner. Bit of a bounce this morning, up 0.4% on the S&P 500, fading some of last week's losses, taking a small bite out of them anyway. Last week, yields were higher by double digits. We had some more weight to that, up 5 basis points on a 10-year, 457.27. Under surveillance this morning, Fed officials urging patience.
I don't see urgency, and I see lots of reasons for patience. And over the longer term, I think my expectation is that we will ease, and that over the longer term, interest rates will be at lower levels. My baseline would still have us starting to ease later this year, but when I see is likely to be later than I had been previously thinking.
It's the latest this morning. More Fed speak later on today from Presidents Logan and Daly, as well as our interview with New York Fed President John Williams, 8:30 Eastern Time. Williams reacting to the latest economic data with retail sales due at the same time. PIMCO's Andrew Bors writing this: we believe that US growth has likely peaked and will gradually decelerate towards the rest of developed markets, yet the factors that have contributed to US resilience could continue to support the still slowing economy for a while longer. Andrew joins us now. Andrew, let's get straight to it. It's great to catch up as always, sir. What is behind that divergence, that US exceptionalism, the US versus the rest of the world?
I think part of it is fiscal policy. In the past, fiscal policy in the US has continued to provide a supporting role. I think part of it comes from the investment around AI, and I think that's been a positive factor as well. I think it continues to be really hard in the kind of post-COVID environment to figure out exactly where we're going to shake out here. But the other thing has been that there's been less impact from the monetary policy tightening in the US, maybe compared with more interest rate sensitive markets where mortgages are floating rate mortgages. So a combination of these factors, but it does look like you have this US exceptionalism compared with the rest of the world. And, the recent data suggests that continues into this year.
Andrew, is that fiscal impulse a reason to avoid US duration?
I think overall, the level of US interest rates now, high quality bond funds in the US look attractive. So I think that fixed income here looks attractive in the US. But in terms of tactical positioning from our point of view, non-US duration looks like a really good complement. So the UK, Europe, Australia, Canada, the places where you can have a little bit more confidence, I think, that the slowdown has already happened clearly, and this can give you a little bit more confidence, I think, in terms of the inflation path. The strength in the US, remains an issue. The Fed needs to see some slowing down in terms of the activity in the US to be confident in terms of the inflation path. So overall, I think high quality US fixed income looks pretty good, but complementing this with the rest of the world, I think makes a lot of sense just in terms of the balance of risks. Maybe there'll be more ongoing US exceptionalism.
This is a bit of a shift for you, right, Andrew? I mean, a couple of weeks ago, you were quoted in the Financial Times saying you were looking outside of the U.S. for duration more significantly because of this concern about stickier inflation and higher yields. Are you saying that given the rise that we've seen, 4.6% or around that for a 10-year is fair value and you'd be a buyer here?
I think two things. I think the first thing, go back a month, the level of yields in the US looks pretty attractive. It makes sense to have the global diversification, the global duration positioning. But overall, I think the level of high quality fixed income looks pretty attractive there. So there's a nuance. You like US duration and you like the rest of the world as a diversifier and in terms of the balance of risks that we see there. Yes, then the second thing, as you alluded to, since we put on some of these positions, since we've been talking about this, the trade is moving in our direction. It was interesting last week with some of the repricing in terms of policy rate expectations. You weren't seeing that, say, for the ECB. So the trade has been moving in our direction. But I think at this point, still in the global portfolios I manage, for example, overweight the rest of the world versus the US continues to make sense. But as US yields creep higher, then over time we'll need to reassess that.
There is a concern among a number of different investors that at some point this Federal Reserve is going to have to start thinking about rate hikes if we start seeing inflation remaining so sticky. How are you sort of gaming that out? Does that seem like something that you have to start factoring in?
I think that's a low probability in terms of the outlook for this year. I think that the Federal Reserve is clearly expects to be easing policy second half of this year. Chairman Powell has been quite clear on that, other Fed communications, but the market has been pricing out expectations in terms of rate cuts. We think appropriately there's a lot priced in at the start of this year, given what's been happening with the data. It now looks broadly fair to us. So I think it's a low probability that the next move is higher, but the closer as you reduce expectations in terms of cutting, then those risks just mathematically have to become larger in terms of how you think about it. And I think it's an important distinction. You have had the pricing out of rate cut expectations in the US, and this has gone along with perfectly good performance in terms of equities, credit markets, more broadly risk assets. I think it would be more of a surprise, more of a market event were you to have a shift to expectations for rate hiking. So not our expectation. I think market pricing looks broadly fair for the US.
There's also a question about how much the rest of the world can diverge from the United States and from the Federal Reserve policy. Yes, the ECB indicated that they were sort of laying the groundwork maybe for a June rate cut. How far can that go given some of the currency reactions? I'm thinking, for example, of the yen that's the weakest going back versus the dollar since 1990.
Right. So I think the yen is an interesting, important point. If you start with Europe, I don't think there's a great deal to stop the European Central Bank, the Bank of England, and others from easing policy. You are seeing differentiation across countries in terms of the GDP and maybe in terms of the inflation data. And these countries have gone through significant slowdowns, technical recession in Germany, technical recession in the UK. And so I think that there's not a great deal to stop them moving ahead. Again, market pricing looks pretty reasonable. And I don't think that the euro, say, in that context is going to be a concern for the ECB. The Japanese situation is different in the sense that, clearly the authorities have expressed concerns about the yen. It tends to be about the pace of the movement, not the level only, but there have been concerns expressed there. But it's not at all obvious that this is going to lead to any faster pace on the part of the Bank of Japan. So jawboning in Japan, keep an eye on that. In the case of Europe, UK, Australia, others, I don't really see anything significant in terms of currency markets which will hold them back. So a different sort of cycle to the ones we've had historically, but I think just greater differentiation across countries. And again, it makes sense for us to position for that in FX markets as well as in rates markets.
Well, let's talk about what that means, Andrew, just briefly. Does that mean additional dollar strength?
Well, I think that in particular the European currencies, given the path for the ECB and then given valuation, I think that something like Australia, Canada, the UK express this differentiation view using interest rate markets. In the case of Europe, the baseline, the valuation not quite as attractive, but the FX, I think, position currencies like the euro, Swiss franc, Swedish krona. I think kind of a broad European beta underweight via currencies is a good way to position for, again, the risk of ongoing US exceptionalism. In the baseline, I think the US should slow down second half of the year. The Fed should deliver pretty much what's priced in terms of easing, but the balance of risks maybe is towards US exceptionalism, and so the FX positioning is another way to prepare for that.
Interesting. Andrew, this was brilliant. Thank you, sir. Andrew Balls there of PIMCO on the limits of central bank divergence and maybe pushing some of that through the FX market, looking for a stronger dollar. Lagarde last week, we're not Fed dependent. I think the governor of the Bank of Greece said it. It's time to diverge. Let's talk about how far they can go. Coming up very shortly, we'll catch up with Peter Cheer of Academy Securities, Terry Haynes of Pangea Policy, Tom Michaud of KBW, Marilyn Watson of BlackRock. The second hour of Bloomberg Surveillance up next.
You've got very sort of mixed signals coming from markets, active risks in various parts of the world, including the Middle East. These are all risks that investors have got to take on board right now.
This is both a international and domestic story, but also very much a DC in market story.
The 10-year, the dollar, and oil are super critical. That macro trio is what's really going to dictate what happens going forward.
All this talk about rate cuts, and we remember the market does not care. The market has been concerned with earnings.
Ultimately, when the dust settles on 2024, we will still be talking about a situation where the U.S. economy is growing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Big couple of hours coming right up. Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance begins right now. In about 30 minutes' time, we'll get numbers from Goldman Sachs. 1 hour after that, US retail sales. And don't miss this, an exclusive conversation. Mike McKee sitting down with the New York Fed President, John Williams. We begin this morning, though, in the commodity market, down 0.7% on Brent, down 0.8% on WTI. New prices on the board here, Bramo, 84.98 on crude, 89.83 on Brent.
It could have been worse. That seems to be what this market is suggesting after a weekend of fireworks of more than 300 drones and missiles that were blown up before or in Israeli airspace by Iran. But this raises the question of, okay, what's next? This is not the last salvo, given the fact that Iran, for the first time, crossed Israeli airspace at a time where there are a whole host of conflicts that are brewing.
Norman Rule, to start the show this morning, the former senior U.S. intelligence official saying this is a new Middle East. Iran has indicated the matter can be deemed concluded. We're still waiting to find out whether Israel sees it quite the same way.
I don't think Israel's going to see it quite the same way because they are going to have to respond to this existential threat, a red line that was completely erased with more than 300 drones and missiles sent over directly from Iranian soil. Brent McGurk, the Middle East director of the National Security Advisor for the president, said this to David Ignatius over the weekend. It was a worst-case scenario in what Iran launched, but a best case in terms of outcome. And that's why the oil market's taking a breather. But to Lisa's point, this might not last.
How and if Israel responds? We know based on reporting that the President of the United States reportedly told the Israeli leader, you've got to win, take a win. We'll see if he sees it quite the same way, as a win and a win he wants to take.
There's so much that can happen. From a market's perspective, it's very difficult to know how to price this. There is a question, though, and Nadia was very good with this, which is what is the risk premium that's currently being baked into markets when it's not just the Middle East, it's also Russia sanctions. There are a whole host of issues that could cause commodity prices to go even higher from here. How do we factor that in, given the fact that we are seeing inflation tick up and this economy handle, at least in the United States? This really creates a pretty unsettling backdrop for a market that already wants to pull back and rates that have already sold off.
It certainly feels like we've got a new floor for crude, just trying to work out how high the new ceiling might be in the crude market right now. We're negative by 0.7% on Brent crude at the moment. Just a programming note, John Kirby, the National Security Council Coordinator, joining us at about 8:20 Eastern Time, so don't miss that conversation as well. Just to get you started with the scores this morning on the S&P 500, positive by 0.5% on the S&P right now. Yields a little bit higher, taking back some of Friday's move. We're up by 5 basis points, 4.57. And there's your move in the crude market, down 0.8% to 84.96. Coming up this hour, we'll catch up with Peter Cheer of Academy Securities on managing geopolitical risk. KBW CEO Tom Michaud on bank earnings, looking ahead to Goldman in about 25 minutes' time. And BlackRock's Marilyn Watson on the prospect of much higher for much, much longer. We begin with our top story, market steady, as investors see little immediate risk of escalating tensions in the Middle East. Peter Cheer of Academy Securities detailing his game plan for managing geopolitical risk, saying he's neutral on rates, bearish on equities and looking for a pullback in credit. He still likes energy. Pete's with us around the table. Pete, good morning to you.
Morning, John.
You wrote about it over the weekend, the difficulty of pricing in geopolitical factors when there are multiple other factors taking place at the same time. How difficult is this moment?
I think it's incredibly difficult, right? There's so many mixed messages going on between what Israel should do, what Israel thinks they need to do. And I think we're now talking about this direct attack by Iran, but let's not pretend that Iran hasn't been directing or actually helping the Houthis and Hamas. So this is just a new evolution in this conflict, and I think it's actually going to get worse before better, unfortunately.
Talk to me about the weekend. You've got a whole host of generals on the team over at Academy Securities. What were they telling you in real time as this was developing Saturday night into Sunday morning, and how did they respond to it?
You know, I would say in some ways this was the best case, that it was a fairly telegraphed and relatively weak attack that was relatively easily defended. I think our biggest takeaway is really that so many other nations in the area helped shoot down the missiles and the drones. So I think that's an important takeaway, right? It's not that Iran has the entire Middle East on their side. They are still maybe a little bit isolated in their attacks on Israel. So I think that's one very positive, and that's got to weigh on how Iran thinks going forward. Other than that, though, I think it's very depressing. And, I think one person said it, attempted murder is still attempted murder. So whether it was a successful attack or not, they did breach something that has not been breached before.
When you look at the Middle East waking up this morning, no physical supplies have been hit on the oil market. Oil continues to flow. So how concerned are the generals about other areas? Because we have seen these skirmishes in the Red Sea, but also the Strait of Hormuz.
I think we believe that we are really the only ones who can control the Straits of Hormuz, that Iran says they can close it down. That's fairly unrealistic. We think we have the capability to defend it. We can stop it. We are the only ones who can do that. So I think we're not too worried about that. Having said that, I think everyone realizes that Iran is shipping missiles to Russia. Some of those are coming off of EU sanctions and will be allowed. We still don't allow it, but again, that's not been something that's been easily enforceable. And I think the same is going to apply to oil, right? Oil is selling a lot, Iran's selling a lot of oil, mostly to China, a little bit to India. That's not been stopped. And it's very interesting when you look at the globe, right? It seems that there's less and less disrupting Chinese flows or Russian flows, and more, disrupting Western potential flows, not just in oil, but in goods and services. So that's a risk I think we're starting to face, and I think that gets worse.
And there's so many knock-on effects. So if the United States was to come out and say, start enforcing Iranian sanctions, prices would go high, and then Russia would actually have a higher premium to bring in more dollars. How do you view what the United States potentially might do? Do you think it's going to be more sanctions enforcement?
I think we're hoping not to have to enforce those sanctions. Again, if you go back even to what's going on with Russia and Ukraine, I think there's been some directives at Ukraine not to touch the Russian oil refinery. So there's a lot, I think, that's being played out in the oil markets. Go back to our strategic petroleum reserves. They were never really refilled either. So we have less kind of tools at our disposal to do this. And I think every incumbent's very worried about inflation coming in the election. This is, going on. And the one positive side to the energy use is that we're not talking enough about it. I think as data centers get built out, we're going to have to use more and more electricity. That's going to drive domestic demand. And you look at the success India's having in terms of their growth. So India is starting to become a bigger and bigger consumer of commodities. So I think there's a lot of commodity pressures coming from both positive factors and then all these risk factors that I don't think are fully priced in yet.
So you have the privilege of taking all of this and trying to come up with some sort of market thesis. How has it been?
It's been very tricky. I think, it's been very helpful because the one thing is it does help us kind of get below the fold, right? These generals have experience in the region. They talk to IDF commanders. They know what they would have done. Many are still plugged into D.C. So I think we've got a pretty good read of what's going on. Having said that, that just takes out a lot of the noise. There is still a lot of range within going on, and it's very hard to figure out how these various countries are going to respond. And reality is we've never probably quite so publicly, quite so directly told Israel what we want them to do. And how are they going to behave with that?
But just shifting away, there's so many other stories, as you mentioned. There's the earnings story with the question of valuation. There's something that you pointed out. There's been almost no consistent pattern between rates and stocks. How are you sort of shifting your understanding of how high yields can go and what the stock relationship could be, given that earnings so far are inconsistent at the very inception of earnings season?
Well, it's interesting that you asked that because pulling up today, two top stories on Bloomberg are about Tesla having to lay off some people and Apple's sales in China. And again, going back to our theory has been that China is going to try and more aggressively sell their brands globally, suppress sales of our brands domestically. And I think that's something we're not yet facing is this potential earnings pressure and margin pressure U.S. companies are going to face as China sells their brands. I keep coming back to BYD. I literally never really knew what a BYD was 2 years ago. To me, it was always Boyd Gaming. That was the ticker symbol for the stock. And now it's this EV company. And they don't yet sell EVs in the U.S., but you see this kind of pressing across the globe. And I think that's where the retrenchment's going to come is what do we do as we face competition from Chinese brands? That's a risk that's just starting to filter into the market. And I think that's going to put pressure on stocks.
Pete, another reason not to like stocks. So let's talk about what the haven is. The optimal haven is always defined by the nature of the dominant risk. What is the haven right now with that in mind?
I still like commodities and energy. I think that's a growing use, again, even within the U.S., right? As we build out these data centers, talking to people who build the data centers, getting access to the power needed to power these data centers is one of the biggest problems they're facing, and where do you cite these, where do you put these? And it is going to be a domestic phenomenon. I think we mentioned before, but more and more companies are realizing if they're going to be processing their data, if they're going to be using AI, you want to be doing it on domestic soil with domestic people, because it reduces, doesn't eliminate all the cyber threats, but it does reduce that. So that's a growth area, and all these put pressure on energy. I don't think yet we're seeing anywhere near the potential disruption we're going to see in the Middle East and elsewhere. So that's where my favorite.
Let's just finish on that disruption just briefly. You've got quite an original view on this. You believe that hot wars like the one we're seeing take place in Ukraine and again in the Middle East is a reason not to like treasuries. Can you just build that out just a little bit?
Yeah, and again, briefly on Friday, we had that traditional flight to safety, right, where treasuries rallied. But I think this time it's going to be very different, because reality is everywhere these hotspots are, it's going to affect oil prices. It's going to affect oil prices potentially dramatically. We have fewer things that kind of combat that near term. And I think people are going to realize, oh my gosh, we all need to spend more on defense, not just us, but Europe, everywhere. So all of a sudden the conversation is going to be like, oh, this is bad for global trade, which is already deteriorating. But it'll switch too quickly. Oil prices are going higher, commodity prices are going higher, and everyone's going to run bigger budget deficits. And given positioning on where we have been in yields, I think we can go higher. Now, we kind of hit the high end of my range, 460, so it's hard to be like pounding the table bearish anymore. But I do think there's much more risk of getting to 5% than 4%.
Interesting. Pete, thank you, sir. Deeply thoughtful stuff, as always. Peter Cheer over at Academy Securities. Brent crude right now, 89.82. We're negative 0.7%. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. As Peter mentioned, Tesla is set to cut more than 10% of its global workforce. The car maker is grappling with a slowdown in EV demand. Those cuts would be more than 14,000 employees. In a letter to employees, Elon Musk cites a duplication of roles and job functions in certain areas. The PE giant CVC has revived plans for an IPO in Amsterdam. It's seeking to raise at least 1.25 billion euros. Its investors in a listing that potentially paves the way for other PE firms to go public. The Biden administration is planning to award Samsung as much as $6.4 billion in grants to increase chip production in Texas. All of it is part of a U.S. effort, the idea being bolster domestic semiconductor manufacturing. The money will also be used to expand Samsung's existing facility in Austin, Texas, and it will support U.S. aerospace, defense, and automotive industries, according to the Commerce Department. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on this program, Trump slamming Biden on Israel.
We were respected 4 years ago all over the world. Today, we are considered a joke. Ukraine would have never happened. Israel attack, both October 7th and today, would have never happened.
That story up next, live from New York City this morning. Good morning. Let's get you over to the price action. Equity futures on the S&P 500 positive by, let's call it 0.5% on the S&P. Yields bouncing back by 5 basis points, 457 on a 10-year, and crude a little bit lower, negative 0.8%, 84.94. Under surveillance this morning, Trump slamming Biden on Israel.
Before going any further, I want to say God bless the people of Israel. They're under attack right now. That's because we show great weakness, and it would not have happened if we were in office. You know that. They know that. Everybody knows that. We were respected 4 years ago all over the world. Today, we are considered a joke. Ukraine would have never happened. Israel attack, both October 7th and today, would have never happened.
It's the latest this morning. Former President Donald Trump claiming the weekend's events would not have happened if he was still in the White House. Today, he'll be in court, the first president to sit for a criminal trial. Bloomberg's Katie Lyons joins us now here in New York City for more. Morning, Kaylee.
Well, good morning, John. This is going to be a historic day. As you mentioned, this is the first time a former president of the United States will be in a criminal trial. Of course, in this case, brought by Manhattan District Attorney Alvin Bragg, he is charged with 34 felony counts of falsifying business records. The allegations essentially that he illegally concealed payments to porn star Stormy Daniels and hush money in the days before the 2016 election. Now, Trump has denied all of these charges. We could at some point in this trial actually see him testifying, taking the stand himself. And we also expect potential witness testimony from Stormy Daniels herself, as well as Michael Cohen, who the former president's former attorney and fixer. All of that, though, will come later. What really starts today is jury selection. They are going to do the hard work of trying to find 12 jurors who can be unbiased and fairly judge former President Trump in this case. Of course, he has a very high name recognition as a former president and current Republican presumptive nominee. So they will be asking them questions as to whether they have ever attended a Trump rally, whether they have a True Social account. This is a process that could take some time, potentially 1 to 2 weeks. The trial in total could take up to 8 weeks.
Kayleigh, what are the political implications for today? Because when we poll voters, what they say is that they do like Trump, but potentially they sour on him because of the legal issues.
Yeah, certainly we have seen that in January. Bloomberg did a poll with Morning Consult that found in the 7 swing states that are likely to decide this election, more than half of voters say they would not vote for Trump if he were to be convicted of a crime. Now, of course, being convicted of a crime doesn't actually prevent him from running or even obtaining the presidency, serving as president, but it could change the minds of voters. The other thing we have to consider is that Donald Trump will be here today. He has to be in the room for every day of this trial, which will take place every weekday except for Wednesdays, for, again, a period of potentially up to 2 months. That will take him off the campaign trail. It also will cost him a lot of money, millions of dollars in legal fees that could impact financing for other campaign-related events. But what we have seen historically is that Trump uses court appearances like the one we will see today and then the weeks that follow to galvanize his base, to kind of use it as a way to obtain free media, plead his case, not just that he feels this Department of Justice is being weaponized against him and intended to keep him off the campaign trail, but also talk about really whatever he pleases. This is the strategy that has worked for him thus far in his presidential campaign, but we'll see if things start to change, as potentially we could see him ultimately be convicted of a felony here.
Katie, looking forward to your coverage throughout today on Bloomberg TV and radio. Katie Lyons there here in New York City. With us now is Terry Haynes of Pangea Policy. Terry, compare and contrast the president in the Situation Room, the former president in court. How's this playing out with the electorate?
Well, I think it's generally not a good look for Trump. The bottom line on Trump right now is that he's struggling to try to unite the party, and my prediction is that he won't, and I think can't. And at the same time, he's already underwater with independent voters. He needs a unified party, and he needs a majority of independents to win, as he did in 2016. I tend to think, on balance, this drives people away. At the same time, Biden's got a terrific opportunity, in a political sense, to come out, not only look like a leader, but be a leader and unify his party, attract independents by, frankly, being strong and resolute and showing a lot of energy. And, we'll see if that happens.
Terry, we know that Donald Trump has been speaking with House Speaker Mike Johnson about potentially next steps when it comes to either providing financial aid to Israel and or to Ukraine. Do you have a sense of what that influence does to the likelihood of getting something through this week?
Well, I think all it does, Lisa, is let me start here. What the House is going to do this week is very much up in the air. Let me just say that. Secondly, they're very focused on Israel. Thirdly, if I were the vast majority of members in the House who want Ukraine aid, I'd be rattling the saber on a discharge petition very hard. You saw new current member Tom Suozzi go out with this in the Wall Street Journal, saying, the time is now to unify around, doing something on Ukraine. So I think what's happening here is that Trump's probably got Johnson's back on the alternative ways to fund those things, the kind of lend-lease plans and other forgivable loans and the other sorts of things that have been bandied around. And it kind of puts it puts the opponents of that, the Greens of the world, kind of on the back foot.
What do you make of the fact that President Biden was so quick to say that the U.S. would not support Israel if they retaliated in any way against Iran?
Well, your word this morning is contained. Mine is restrained, and I think that's a restraint. I think it would be naive to expect Israel to make no response to this, but it is going to be proportional in the Western sense of how we understand that. Iran's response, of course, wasn't proportional, which is one of the things that that has caused the current problem. I think what you've got here is you've got a very ad hoc coalition, as Norm Rule said in the last hour, that's going to take things more or less on a case-by-case basis. There's a lot of encouragement, though, and in how and why people responded, and not least among those was the way that Jordan stepped up to not only defend its own airspace, but to send a message that there are greater interests in the Middle East than Iran, and they're going to defend themselves and defend those interests as well. That was all very good.
Terry, you say that the president could make a win over this domestically, can look resolute, can talk about being a strong leader. But the fact of the matter is, Biden told Iran don't, Iran did, and the president is telling Netanyahu reportedly to take the win. How does that exude confidence and strength?
Well, I don't. That's a very good question, and the answer is I don't think it does. I went out to markets pretty strongly on that point yesterday. This is an administration to me that's been defined by the straddle. My 2 cents of unwanted advice to the Biden White House is they'd be better off not straddling and better off talking about what they're for, how they're for, and what they're trying to do. They will not only get stronger support from broad swaths of the American public, but even those who disagree will respect the idea that they're pushing in a particular direction and doing things in a particular way. You can't have this always, and the last 3 or so years, I think, is fresh examples of that.
Terry, why do you think the president left for Delaware before these strikes that the U.S. was preparing for? And I'm curious because I want to know what this administration is learning or potentially not learning. Biden did this as well when he went to Camp David when Kabul was falling. Why continue to leave the White House when you're trying to project this image of strength?
That's a better question for Admiral Kirby than for me. But I think what they do is assume that things are normal until they're not, and they want to project the image of normality until things aren't. Frankly, it also, the president's plugged in from anywhere in the world. So, where he is doesn't completely matter in terms of fulfilling his own duties. But, the visual is it attracts, it's a little bit more dramatic and shows him energetic and on top of things. And they probably consider that as well.
Terry Haynes, thank you, sir, of Pangea Policy. I'm sure if we ask, we won't get a good answer, but Annmarie might try. In about 1 hour's time, we'll catch up with John Kirby, the National Security Council coordinator on the events over the weekend. In about 5 minutes' time, 6 minutes' time, we'll catch up with this guy, Thomas Show of KPW, the CEO, on bank earnings. Goldman Sachs numbers about 6 minutes away. Big bank earnings kicking off on Friday, Bramo. Then we push forward to tomorrow, I think. We get Morgan Stanley and the likes of Bank of America.
The expectations are actually higher for Goldman Sachs than, say, before we got some of the JP Morgan, Bank and Citigroup earnings, just simply because banking revenues came in significantly higher, and there's this expectation of the IPO calendar and debt issuance coming in stronger. So a lot of people are going to look at how Goldman Sachs capitalizes on that.
What did you think of the gloom being outgloomed by Jamie Dimon over at JP Morgan? If you missed it Friday, this quote: "The global landscape is unsettling. Terrible wars and violence continue to cause suffering and geopolitical tensions are growing. There seems to be a large number of persistent inflationary pressures which may likely continue." Some comments in the mix as well on QT, quantitative tightening. We do not know how these factors will play out.
This is just a bank that is sort of making incredible revenues, right? So they just did deliver incredible revenues, albeit with net interest margins that didn't exactly wow anybody. But on the other hand, they're looking at companies that are trying to straddle, that's the word of the day, I guess, straddle some really challenging moments. I think that right now, that's what we're going to hear from a lot of executives.
I was a slight cynic when I saw Jamie Dimon come out with that because everyone was focused on the stock. The market was focused on this net interest income that didn't get to the place that they wanted to. And yet he's like, but actually, there's more concerns over here.
We're focused on the numbers from Goldman. First quarter fixed sales and trading revenue, $4.32 billion. The estimate, $3.64. So that's $4.32 against an estimate of $3.64. That's a tidy upside surprise. First quarter net revenue, $14.21 billion. The estimate, $12.98. We'll get into that beat in just a moment. That stock is up in the pre-market by more than 2%. We'll catch up with Sonali Basak in just a moment and Thomas Show of KBW. Goldman Sachs looking pretty good this morning. Here's the stock price. The market action looks like this. We're up 3% in the pre-market. Sales and trading beat. Investment banking beat. Advisory beat. Shnali Basak, it's hard to find a miss in this report this morning.
There are almost no misses in this report. And when we say they beat by a lot. You look at their return on equity, for example, they came in at nearly 15%. The market was expecting 11%. You look at fixed income trading, it more than doubled from the prior quarter. And it beat JP Morgan on equities, coming in above where Morgan Stanley is expected tomorrow. They not only beat their expectations, they set the bar higher in all those traditional investment banking businesses. And remember, John, Goldman coming into today was trading at a lower price to book ratio than all of its investment banking peers, besides, of course, Citigroup.
Let's take one line, fixed sales and trading revenue. You went there, 4.32 billion. The size of this beat, the estimate 3.64. Is the pie getting bigger, or have they just taken someone else's slice this quarter?
Well, that's interesting you ask, because, of course, we've lost some banks in the last couple of years in this business. But remember, Goldman is sending out a calling card, and that is we're willing to lend. We're willing to lead with our balance sheet. It's not just about the idea of volatile markets here. It's financing. They had a record quarter of FICC financing, as well as the second largest quarter ever in equities financing. And so you're looking at Goldman leaning in more on those traditional businesses and saying, remember that consumer foray? We're almost done with it. A lot of those figures, those messy figures that you used to see in that front page for the last year or so of Goldman, that is almost gone. It's in the tens of millions now. They're cleaning up their act, and they are leading on the businesses that they've always known best.
Basically going back to the bread and butter rather than the consumer banking and some of the other issues. Can you give us a sense, just to sort of put this in scale, what stage of the reboot is this for David Solomon as he tries to reorganize and refocus Goldman Sachs?
Well, there's one big question, and you were asking, is there any misses? There's one slight little miss, and that is in asset and wealth management. And so as Goldman shifts the firm here and focuses on banking, investment banking, trading, they are also trying to show the street that they're almost a $3 trillion asset and wealth manager as well. Now, record assets under supervision, but how do they keep setting that bar higher? They have new management there, and that miss is very much attributed to the changes you're seeing in the asset and wealth manager. They sold some businesses there too, but the sustainability of that business is going to help it try to get that Morgan Stanley premium that's existed over Goldman for the last couple of years.
You've mentioned Morgan Stanley a few times now. They report tomorrow morning. Do you think there is a read-through from this into them tomorrow?
Well, like I was saying, the bar is very high now for equities trading for Morgan Stanley. Remember, Ted Pick taking over, that was his business, John. And so what I'm hearing on the ground is that he's been pretty aggressive there and trying to take back that share that Goldman has gained in the last couple of months.
Stock is up by 3.6% at the moment, at least. Elsewhere, looking at Morgan Stanley, the stock is up by about 1 full percentage point in the pre-market. Morgan Stanley reporting tomorrow morning. With us around the table, together with Shnali, KBW CEO Tom Michaud. Tom, you've had a few minutes to go over this one. What's your reaction to this?
So our feeling is it's two things. One is it's what's happening in the industry. So there is a rebound that's happening in investment banking. Investment banking was on a real downturn over the last prior 12 months. And what you see at Goldman is not even full power. I mean, we still think the industry, broadly speaking, is probably operating around 70% of what we would think is typical. So as we put the COVID period behind us, get to a more traditional moment, as IPOs pick up, M&A comes back, and especially if we get lower rates, we think the business has even further to go. So that's number one. Number two is, I think it's a big moment in the Goldman reboot. They also sold Green Sky in the quarter, which is putting some of their consumer efforts behind them. And they're going to focus really on what's been the core of the company over the long term. We've been really positive on the shares. My sense is we'll continue to recommend it even after today's move. And as the company earns around 16 on tangible common equity in this quarter, it's a signal that they're starting from a very healthy point, even this reboot.
Something that Shnali said that really stands out, because it seems like a lot of banks are implying the same thing in their numbers: use of balance sheet. We're hearing that again and again, using their balance sheets more aggressively. Is this the new model, kind of going back to the old one as they try to compete with private credit and private asset managers? They got to use their balance sheets, and they find ways to do it even with all the regulatory.
Well, I think that's going to be key, because we've just gone through a moment where the banks in general have lost market share to non-banks. And I personally believe in a 5% yield world with a flat or inverted yield curve it's going to be harder to get financing than when money was free during COVID, okay? So having access to a balance sheet that's reliable is going to become more important to banks' clients. And over time, it could be part of the moment that helps these banks regain some share from that moment in time.
Forgive me, there were years when a lot of these bank executives were saying that they can't do this, that they are hamstrung, their hands are tied because of financial regulations. What changed?
Well, believe me, I don't think any bank's going to step outside of the financial regulations. I think it's just core blocking and tackling, which is having reliable access. I think what's changed is the other markets aren't as easy. So zero interest rates meant that it was very easy for non-banks to be able to raise financing, to be able to enter the market. It's going to be harder for non-banks to raise funding to serve bank customers. So I think that's what's changed. Not the banks, but I think it's the other items and other conditions.
You said you like Goldman Sachs. Sonali was talking about how Ted Pick, his whole business has been really the trading, and potentially we'll get a read through Morgan Stanley tomorrow. What other banks do you like?
Well, we like Truist. It's one of our favorite ideas. It's one of the biggest banks in the nation. They sold their insurance broker for a whopping price recently. They're going to trade, and what you don't see now is that they haven't put the gain into their financial statements yet. So the stock's really trading around 115 a tangible book, which is a very low valuation for one of the best banks in the nation. It's got a 5.7% yield. The next time that dividend changes, it's going up, not down. So our view is at a single-digit PE ratio for a bank that's got one of the best franchises in the country. That is, I would say, our largest bank idea at the moment, and we're pretty bullish on that one. And then, they're also doing a restructuring. They got a little bit offsides after their merger, and we think the new management team is very focused on fixing things.
When you look at the loan market at the moment, what do you make from it? Because I know in your notes you talk about the seasonality of it.
Slow. It's slow. What we're seeing in all the results that have come out, loans have actually been a little bit lower than we expected. And when I watch, look, we've had 3, now 4 banks report. Our firm files 225. We got a long way to go. But what do I think? I think delay in the pivot. So our bull case on the stocks, and we're market performed, so the bull case, we're pretty balanced. But the bull case is that we're going to get a pivot and acceleration into earnings going into 2025. To the extent that we get less rate cuts, less growth, it probably pushes that back a little bit for when we see an acceleration in earnings.
How aligned are you with the gloom of Jamie Dimon over at JP Morgan? What did you make of the caution from him on Friday? Typically, we're all used to sort of beat and raise from JP Morgan. Then on Friday, things kind of changed. What do you make of that?
There are still big macro risks in the marketplace. And I'll tell you, when I talk to bank management teams, it's almost like I feel like I'm having a credit analyst discussion more than an equity analyst discussion. They're very focused on their own balance sheet. I think strength and stability seems to be a bigger presence in the strategic boardroom of these banks. They are building these banks to make sure they can withstand any challenge.
Hey, Tom, if you look at the way Goldman and Morgan Stanley have been trading, they've been bears. Morgan Stanley's down more than 7.5% over the last 12 months. Does it deserve that? Are these kinds of investment banking and trading businesses just something people don't want to pick up on in this environment?
I think for Morgan Stanley, it's just a preference for Goldman Sachs for us. We had been really bullish on Morgan Stanley. We pulled back. It's just the dynamics of what's happening in their own earnings at the moment. We just think there's more upside because there's more delta coming at Goldman. They can do a little bit more self-improvement, and so we like it more. But so we're market perform on Morgan Stanley, but think it's a fine company. We just think the dynamics don't have as much delta to them.
Sonali Basak there alongside Tom Michaud of KBW. Just looking through the numbers just to wrap things up, Sonali, quickly. Beat. How would you frame it any other way for Goldman Sachs this morning?
There's no other way to frame it. Remember, they've only been trading at 1.2 times book value heading in today. Morgan Stanley's at 1.5. It sets the bar super high for tomorrow. And remember, there's a big cloud over Morgan Stanley with a lot of questions about the investigations that they're facing. They haven't said anything yet. And so the earnings are one thing, but then the story is also going to be equally important headed in tomorrow.
Let's get the scores up on the board again and just look at Morgan Stanley going into earnings out tomorrow morning. In the pre-market, it is positive off the back of what you're seeing on Goldman Sachs. Goldman up by 3.4%, just beats across the board. And we talked, Lisa, briefly about the nature of the upside surprise. Let's just sit on fixed sales and trading revenue just for a beat longer. 4.32 billion, the estimate 3.64. That is a solid beat.
And it really raises the question, okay, they're using their balance sheet more, so that means they're making directional bets or taking things down in a market that might look like it's liquid, but may not be as liquid. And then it also raises this question about just how much they're taking share from some of these other companies, just in terms of private asset managers, which is something a lot of people have been talking about.
But also to remember, we don't have Credit Suisse anymore. So a year ago, Credit Suisse disappeared overnight into UBS. So when you look at the statistics, I believe that market share was pretty much captured by many of the biggest other banks. So I think that's also, on a year-over-year basis, been somewhat of a boost.
So when I asked Shanali, is the pie getting bigger, or did they just take someone else's slice? Are you saying that slice belonged to Credit Suisse?
I would say amongst probably others. I would say they're getting a bigger piece of the slice because while I do think, and I think Morgan Stanley will benefit tomorrow from the market just being better, and believe me, as someone who operates an investment bank, I pay attention to league tables and market share, believe me. So the biggest firms have probably picked up the most share, and it's a few firms who have done that, and Morgan Stanley and Goldman would be in that bucket.
What's good for Goldman Sachs isn't necessarily good for Zions Bank, for some of the others that are smaller regional banks. How much is the gain of big banks the loss of regionals?
Well, they tend to do different things. So the net interest income world that they all live in is somewhat similar. It's the investment banking piece that really is the big delta that we've been talking about. So as we get away from banks that report that don't have that, they're going to be more attuned to what's happening in the interest rate environment. The good news there, though, Lisa, is that 6 months ago, we would have been talking about the quantity of deposits. It's all about deposits, the quantity of deposits. The nice thing is that pressure has eased, and you're already seeing it in the numbers. Now it's the cost of those deposits. And we're waiting for the Fed to cut rates a little bit to take some of the heat off, because you know what? U.S. Treasuries are really competitive for bank deposits. We need the U.S. Treasury rate to back off a little bit for the banking industry to do a little better. And it is actually all about deposits more so than loans.
When you say we're waiting, you mean the banks, because for the rest of us with money on deposit, we're not. We're waiting for them to pass on higher interest rates.
Buy T-bills,
for the
Jonathan.
final time, make it happen.
Online, it's easy to do.
I'm so lazy, Tom. Tom Michaud, thank you, sir. Shanali Bassett, thanks to you too. Goldman Sachs in a pre-market positive by something like 3%. Let's give an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. German Chancellor Olaf Scholz has begun his second visit to China. He's expected to say that Beijing has not acted on Europe's warnings to end discriminatory business practices. Scholz is also expected to question Xi about China's support for Russia's war machine. Bitcoin is set for its fourth halving. Around April 20th, the amount of Bitcoin that miners can earn each day will be cut in half. It's a process that usually supports prices, but this time a $10 billion blow is expected to crypto firms based on current prices. And it is the 128th Boston Marathon. It kicks off today. The city sees a $200 million economic windfall, which would be the largest bump ever for the event since the pandemic, at least. The marathon is set to welcome 30,000 runners who will be competing for a title and a prize of $1.2 million. That's your Bloomberg Brief, John.
Good luck to them. Couldn't do it. We won't be one of them. I think David Kelly, JP Morgan Asset Management. Is David running that this morning?
I'm not sure whether he's running that. He has run, though, I think something like 9.
I think he told us last week he was running that. So, David, if you're watching or preparing for that, good luck, sir. Up next on this programme, pushing back rate cut expectations.
I think that the Federal Reserve is clearly expects to be easing policy second half of this year. I think it's a low probability that the next move is higher.
That debate up next, live from New York. This is Bloomberg. Let's kick it off with the banks. Goldman Sachs doing better than good, a beat across the board. Goldman in the pre-market positive by 3.4%. The read across for Morgan Stanley, apparently looking for more of the same tomorrow morning when they report earnings. Lisa, Morgan Stanley up by 1.3%.
It's interesting that Bank of America is still yet to report earnings. It hasn't had the same kind of boost. This really speaks to the dominance here of the investment banking industry, that this is sort of the revival that people have been waiting for. Goldman Sachs cashed in. The expectation implied here in the market action is that Morgan Stanley will too.
Tomorrow, the focus turning to Morgan Stanley and BofA. They report tomorrow morning. If you are just joining us, This is the setup this morning. The scores look like this on the S&P 500. We're positive by 0.55%. Equities pushing higher. In the bond market, yields pushing higher as well. We had this risk aversion on Friday, just classic risk-off move. Bonds got bought. Yields lower. We're unwinding some of this price action. Yields up by 6 basis points, 457.89. And in sympathy with some of that, Bramo, we're seeing the move in crude unwind on Friday. Some risk aversion going into the weekend, understandable. We're backing away on crude this morning, down by 0.8% to 85.
It could have been so much worse, and a lot of people were looking for the potential for some sort of further escalation. Now it's all about contained, as you've been pointing at. This question, though, of the Treasury response and whether Friday was actually a read-through to the haven status of this instrument is a real good question that still is out there.
Two things on the agenda for the next hour, 8:30 Eastern Time. We'll get US retail sales. After that, immediately after, an exclusive conversation with the New York Fed President John Williams sitting down with Bloomberg's Mike McKee. Under surveillance this morning, pushing back rate cut expectations.
I think that the Federal Reserve is clearly expects to be easing policy second half of this year. The market has been pricing out expectations in terms of rate cuts. We think appropriately there's a lot priced in at the start of this year, given what's been happening with the data. It now looks broadly fair to us. So I think it's a low probability that the next move is higher.
It's the latest retail sales data coming at 8:30 Eastern Time. The latest read on the state of the consumer as inflation continues to run hot. Investors betting on just 2 rate cuts this year, beginning in September. Marilyn Watson of BlackRock saying, quote, "We had expected this to a certain extent. With market pricing of US interest rate cuts looking very aggressive at the start of the year, we believe it is possible that the Fed may at the earliest begin to cut rates in June, but there is a lot of data to absorb before then." Marilyn joins us now to talk about this just a little bit more. Marilyn, let's talk about some of the calls on Wall Street, some big changes. Deutsche Bank pushing things out to December. Mike Gapen of Bank of America, they go from June all the way out to the back end of this year as well. Marilyn, why haven't your expectations changed quite so much relative to the incoming information of the first 3 months of this year?
Yeah, good morning. So obviously at the beginning of this year, there were very, very aggressive rate cuts priced in, which, almost 7 at the beginning of the year, 6 or 7. Now the market is pricing in actually, less than 2 if you look at Fed funds futures. I think, we think it's reasonable to still expect that there may be a couple this year, but there is a lot of data to come. It's possible that they may cut in June, but I think, throughout this year, the Fed has been emphasizing in its communications over and over again that they want to see more data, that they are data dependent. And I think particularly when you do look at the economic data that's been coming through, it has been very resilient in terms of economic activity, in terms of the labor market, which is cooling, but has actually, remained, surprisingly strong, I think, for many observers. And then, of course, when you look at the inflation data, and obviously the Fed has a dual mandate, when you look at the inflation data, then actually it has remained above consensus expectations, for the past 3 months, particularly if you take the CPI data last week. When you look at the services component of the inflation data, then that really is the component that's actually supporting and keeping inflation higher than expected. So I think we do expect at the beginning of this year to see rates higher for longer. And so we do still think that it's, highly likely that there will be some cuts this year. But, I think 2-ish is probably pretty reasonable at this point.
Based on the inflation that we've seen and based on the fact that a lot of the geopolitical tension seems to go directly into higher prices for commodities, how much can treasuries really serve as the haven play in the same kind of way as they have in the past?
Yeah, that's a really interesting point because we have seen treasuries to a certain degree, as you mentioned last week, maybe on Friday, acting a little bit like a safe haven, but then, as you say, they've repriced again now. And I don't think that they're acting the same way that we would have seen in previous similar geopolitical event-type risks or in previous cycles as well. We are seeing, obviously, more of an emphasis on commodities. And I think at the moment, the market just doesn't really know what to expect. No one really knows what's going to happen next. And so I think at the moment, they're sort of looking through what's happening in the Middle East again and really still focusing on what they think the central banks may do what they think in terms of the economic situation, both in the US, but also in Europe and elsewhere. And we had some more encouraging data out of Europe today in terms of industrial production and things. So I think the market doesn't really know how to price, the unknowns in the geopolitical sense. So this just really, again, focusing on the data and on the markets as they see them at the moment.
It seems like the word of the day, at least when it comes to fixed income investing, is divergence. And about the divergence between the ECB and the Federal Reserve, the ability to cut rates in Europe, the divergence with Japan, which has been on its own planet when it comes to some of the rate policies. I'm wondering how much you're on the same page with Andrew Balls, that you're not necessarily avoiding U.S. fixed income, but that you're trying to diversify increasingly to areas that are on a path to cut rates more aggressively this year.
Yeah, so we do have a very, very diversified positioning in our global unconstrained bond fund. We do continue to like, U.S. investment grade in particular. We like, getting some very decent carry, particularly sort of at the front end of the curve in the U.S., where there isn't that much interest rate risk, but you get some, particularly in a lot of the corporates, you do get some very attractive carry. We can just clip the coupons there. But we are also very diversified. So we have positions in European investment grade, for example, where, again, particularly in terms of valuations, when you then hedge them back to the dollar, they're very attractive. We also have positions in Spanish duration. We have positions in Asia as well, also in securitized assets in a variety of those. And we also have positions in emerging markets as well. And I think in this environment, given the divergence that we've already seen, given the repricing we've seen across fixed income markets, then now we can also see a lot more attractive opportunities when we're focusing on a bottom-up perspective. So now you do have a big price differential that we didn't have a couple of years ago in terms of, two potentially similar corporates, but, have very different, underlying fundamentals. And so, at the moment now, we do think there are a lot more opportunities for active fixed income managers really looking at it from a bottom-up perspective, as well as looking across markets, so comparing some emerging markets to some, developed market investment-grade bonds and likewise. So now I think being really, focusing on our high-conviction views from a bottom-up perspective, but also making sure that we're, managing liquidity, managing risk, and really understanding that, in this environment where there is, a great deal of uncertainty, both in terms of, central banks, but also in terms of geopolitical events as well. We want to be nimble, we want to be flexible, and we want to really understand where the income is coming from in our fixed income portfolios and, the liquidity component of that.
Marilyn, wonderful to get your perspective. It always is. Marilyn Watson there at BlackRock. Lisa talking about the extent of central bank divergence we can expect, the limits of it. I think we heard a lot about this last week from the European Central Bank. I talked about comments from President Lagarde, who said we are not Fed dependent. Then we had the Bank of Greece governor speaking to Bloomberg saying, now it's time to diverge. OK, by diverge, do you mean one rate cut and the Fed holds? Or do you mean 100 basis points of cuts and the Fed does absolutely nothing for the rest of the year? Because they're two very, very different stories. And if you're going to push this through the FX market, like Andrew Balls of PIMCO suggested, are we taking euro dollar to 105? Are we taking it to parity? Does that happen with crude rallying another 5 to 10% because of things in the Middle East? I think it's too simplistic to sit here and say you can diverge and then start to talk about the extent of that divergence without really understanding a whole host of issues that surround all of that.
Very well said, especially with respect to oil prices. And this is something that we've heard, that ultimately a weaker currency for Europe isn't that big of a problem unless you start to get that surge in oil prices, which we're already starting to see. And then it becomes somewhat more difficult. And that seems to be what a lot of people are trying to game out.
You get the double whammy of crude back in triple digits and euro dollar back at parity. How many calls are we going to hear about central bank divergence in Frankfurt, Germany?
Suddenly that's going to go out the window.
Yeah, I think that might change pretty quickly. Coming up in the next hour on Bloomberg Surveillance, we'll catch up with Cameron Dawson of New Edge Wealth. We'll speak to the National Security Council Coordinator, John Kirby. New York Fed President John Williams joining us, speaking to Michael McKee exclusively following US retail sales. And we'll break down that number with Tom Porcelli of PGIM. If you are just joining us, equity futures positive here by 0.5% on the S&P 500. Yields are higher too, up 5 basis points on a 10-year, up 6 basis points on twos. From New York, this is Bloomberg.
You've got very sort of mixed signals coming from markets, active risks in various parts of the world, including the Middle East. These are all risks that investors have got to take on board right now.
This is both a international and domestic story, but also very much a DC in market story.
The 10-year, the dollar, and oil are super critical. That macro trio is what's really going to dictate what happens going forward.
All this talk about rate cuts, and we remember the market does not care. The market has been concerned with earnings.
Ultimately, when the dust settles on 2024, we will still be talking about a situation where the U.S. economy is growing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Big 60 Minutes coming up, live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now. 8:30 Eastern Time, 30 minutes away, U.S. retail sales, then an exclusive conversation with the New York Fed President, John Williams, sitting down with Bloomberg's Mike McKee. Bramo, as we look at an aggressive repricing of Fed expectations over the last week.
And we've heard a little bit of pushback from Fed officials that maybe there have to be 2 rate cuts rather than 3, that they have the patience to wait a long time. Key question for me is, how does oil change that parameter? How much does they get does their hand get forced by the fact that commodity prices are rallying for some of the right reasons and some for the very wrong reasons?
Pulling back this morning, let's get to the commodities board very briefly. Brent crude is negative by 0.9%, down by almost 1 full percentage point on WTI. WTI 84.86, Anne-Marie, Brent crude 89.64.
And we've been talking about this all morning, this idea of containment of what the escalation could have been. Brett McGurk talking to David Ignatius over the weekend. It was a worst case scenario in what Iran launched, but a best case in terms of outcome. And that's why you're seeing some of those drivers into the oil market starting to take a little bit of that edge off.
I love talking to people about how you price geopolitical risk, because they look at you like, well, what am I supposed to tell you? I don't have an 8 ball. I can't tell you what's going to happen. And every time I try to hedge, I get my face ripped off. So what am I going to do? But of course, you have to keep watching it. And that's kind of how I view today's reaction in markets. It's not exactly like things are cooling off to a dramatic degree, but people can kind of take a sigh of relief and not make it their front page. That's essentially what markets seem to be saying for now.
Working out what the haven is on any given day is increasingly very difficult as well. I know this is a story that you're on top of. Typically, the preferred haven is defined by the nature of the dominant risk. But the problem is the nature of the dominant risk seems to change from day to day. And the way bonds behave, so say on Wednesday, they were the epicenter of the risk aversion, so treasuries sell off, everything else struggles. Friday, they actually received some demand off the back of risk aversion going into the weekend, which could have driven crude prices higher. So work that out for me, please.
Sure, happy to. I can't. Basically, people are taking a look at treasuries and saying, at what price do they act as a haven? And what we heard from Andrew Balls is maybe at 4.6% on a 10-year, they're starting to look more attractive. But if you listen to Peter Scheer, it's the commodity sector that's going to offset some of the concerns about inflation. And that's going to be the haven bid. Ultimately, the haven of yore is not the haven of now. And that, I think, is what this market is telling you.
And the haven of now, at least over the last month, apparently has been gold, because gold keeps setting new all-time highs week after week. I want to check in on the banks just briefly. Goldman Sachs in the pre-market is positive here by 3.66%. About 30 minutes ago, we just had beats across the board: advisory, investment banking, sales and trading revenue. And there is a positive read-through here, Lisa, for Morgan Stanley reporting earnings tomorrow morning. That stock is up by 1.35%.
You mentioned this before, and I keep just focusing on it because it's such a massive beat. The fixed income currencies and commodities trading and sales coming in at $4.3 billion versus the expectation for $3.6 billion. This is a tremendous beat at a time when a lot of people are seeing a revival of the banking industry, a revival of the trading industry, especially with balance sheet put behind that. Here's the question. How much of a read-through does this have to the rest of the complex, or are they just taking Credit Suisse's book? Are they just taking share from other places and taking share back from some of the private asset managers that are now facing higher costs to raise money?
Pretty incredible execution from David Solomon's Goldman Sachs this morning. Coming up through the hour, let's set up the next 60 minutes for you. We'll catch up with National Security Council Coordinator John Kirby on Iran's attack on Israel. We'll speak to New York Fed President John Williams as markets price out Fed cuts. And PGIM's Tom Porcelli responding to US retail sales due in about 25 minutes' time. We begin with our top story. US retail sales data 30 minutes away. Cameron Dawson of New Edge Wealth saying this on the recent information. CPI and PPI and the sharp move in bonds highlight the reality that the Fed and the bond market mistakenly called the all clear on inflation back in the fourth quarter of 2023 and made the assumption that policy was tight enough to justify cuts. The Fed cannot cut as much as they might like. Cameron's with us around the table here in New York. Cameron, are we deciding that they are insufficiently restrictive, after telling us repeatedly for the last 12 months they are sufficiently restrictive?
The empirical evidence would support that they are not that restrictive based on the backdrop of the aggregate balance sheets of this economy, meaning because you've termed out so much debt, the diffusion of Fed policy simply has not been as sharp as it has been in the past, which is why that the entire time the Fed has technically been restrictive with the real rate positive, the U.S. economy has grown above trend.
Are we at risk of a 2022 market with all of that in mind? This big adjustment in the bond market, how much of a threat is it to U.S. equities?
2022 wasn't just about rising yields, it was about falling growth expectations. 2022 was the fact that the economy and the market thought that if the Fed raises rates, growth is going to plummet. The problem is, or the good thing is that it didn't plummet. And so the bull market of 23 and into 24 has been about rising growth expectations. So the question is, if the Fed stays higher for longer, do we have to start cutting GDP forecasts for 24 into 25? That would be the thing that could move this market into risk off. Without that, then the risk on can continue.
This raises the question about the discussion we were having earlier, which is, are bonds the same kind of haven that they have been in the past? If you believe that this Fed is committed to getting down to 2%, if they do hold higher for longer, presumably you will see some sort of bid into the long end with expectation for slowing growth.
And it speaks to a haven against what kind of risk? Because the risks that we've been dealing with over the last decade, or really 2 decades, have been deflationary in nature, credit crisis in nature. However, 2022 was the sharp awakening to the fact that if it is an inflationary issue, bonds aren't that kind of safe haven trade, which is why we think that if you're going to want to put safe havens in portfolios, it's not just bonds now, it's also commodities, it's energy stocks, in order to have some protection against an inflationary kind of shock.
Can you give us a sense of how much you've shifted that haven bucket away from treasuries to, say, gold, to maybe Bitcoin or not, to potentially other commodities?
We haven't materially. What we find is that over the very long term, when you are looking at commodities, we keep a 5% or so allocation because they are so mean reverting and they don't necessarily trend. Of course, you've had commodity super cycles. What we have been doing is, now that we've seen this back up higher in yields, we are having the conversations of, let's get ready to buy. Once we get to that 4.75, 5% range, you'd have to see another huge uptick in yields in order to offset the base income that you're receiving, which just means that you want to be buying into weakness, not necessarily selling into it.
This has been a really difficult market. High yields haven't hurt gold. Gold's climbed with yields. 1. 2, high yields didn't hurt tech. Tech outperformed last week and small caps got absolutely hammered. The big rotation that everyone was positioning for in the equity market just came undone last week in the face of high yields and higher for longer. Wasn't that the recipe for them to do well, for the banks to do well? And the banks were down about 5% last week.
It's all about the balance sheets. Big tech has great balance sheets with a lot of cash and very little debt. So if you're having a higher for longer environment, you keep raking in all that high interest rates on your cash and you're not seeing your interest costs go up. The small caps are the opposite story. They don't have nearly as much cash. They have floating rate debt. Higher for longer is bad for them. So we think that the real driver of upside is about the balance sheet, and the Fed backdrop for those balance sheets means that higher for longer is bad for low quality balance sheets.
So when does the rotation actually take place in earnest?
I think that the true rotation happens at the beginning of an economic and market cycle, meaning that you're seeing these blips of outperformance. They're short-lived, but they can't sustain because we think we are still fundamentally late cycle. Yes, there's parts of the economy that are early cycle. You're seeing parts of manufacturing do better, which is why high-quality cyclical companies can still be part of the rotation. However, those lower quality names typically only do best early cycle when the Fed is flooding the market with liquidity.
So if I think of the big tech space in particular, I'm struck by the fact that we got news overnight about Apple's shipments coming in much lower than people previously expected. It's some of the lowest levels since the height of some of the supply chain disruptions in 2022. Tesla's reportedly laying off 10% of its workforce, in part because of weak sales in China. At what point does this tech trade get really challenged and it's not just viewed as a couple of idiosyncratic laggards left behind?
That's such an important point because the customers of big tech companies are the rest of the economy. They can only live on an island for so very long, meaning that Meta is 98% advertising. So if you see small business issues, what happens to the trajectory of that sales growth? We have to think about Amazon still being a cyclical consumer company. So I think your point of that you can't have tech be the only thing that does well if you're starting to see economic weakness in other places. But when you think of the names like Apple, I think it's good to remember, it only has 7-8% earnings growth this year and next year, trading at 25 times earnings. That's not nearly as magnificent as what you're getting from Meta, Amazon, Google, and the like.
Okay, meanwhile, we're talking about the potential for a sell-off that everyone's been looking for and that everyone plans to buy. Lori Calvasina overnight was writing about how geopolitical concerns are spiking at a time when stocks already seem due for a pullback. Do you buy into this idea, or do you just think that there is enough cash and enough people who are waiting to get in that it really can't happen, that you can't really get too bearish?
I think that if you were to see a slight shift in narrative, and there's a narrative for every price move, that you might see people put their hands up and stand back a little bit to see what's going on. I think we have seen a deterioration in momentum over the last month or so. You have seen breadth weaken a little bit, but you're not at the point where markets are oversold, which just means that we could still be in this churning environment, even if it's not truly fundamental. We're not changing estimates, but you're just shifting positioning around.
We're about 19 minutes away from retail sales at a time where the data has really made an impact on people's perception of inflation and Fed policy. How important is the 830 number? How much are you watching it to sort of get a sense of how durable this inflationary push really is?
I think this number is incredibly important because we have been in this debate as to whether or not we can trust the employment data. And I think the way that we can judge the employment data under the surface is how much consumers can spend. So if retail sales are strong, it means that employment data is likely holding in better than some of the bears are expecting. The ratio we would watch really closely is the equal weight discretionary versus staple stocks. If that breaks down, it tells you that there could be trouble within the consumer. If it holds up, it means the consumer is just fine, and that means it supports GDP estimates as well, given that's 70% of GDP.
Hey, Cameron, this was great. It's good to see you. Thank you. Cameron Dawson there of New Edge Wealth, head of retail sales, 18 minutes away, and a must-watch conversation with the New York Fed President John Williams and Bloomberg's Mike McKee. Let's give an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Tesla is set to cut more than 10% of its global workforce. The car maker is grappling with a slowdown in EV demand. Those cuts would amount to more than 14,000 employees. Elon Musk, in a letter to employees, cited a duplication of roles and job functions in certain areas. Oil prices are easing after Iran's attack on Israel. Investors, for the most part, betting that the conflict will remain contained, and Axios reporting that the White House would not support an Israeli response. Rapidan's Bob McNally weighed in on the Bloomberg Brief, saying that markets are underpricing escalation risk.
I think it is still. At Rapidan, we actually increased our odds of a material disruption from Arabian Gulf oil and gas flows from 30 to 40%.
And you can watch the Brief every morning at 5 a.m. Eastern. Scottie Scheffler has claimed his second green jacket in only his fifth start at Augusta. He's the fourth youngest golfer to win multiple Masters. Scheffler won by 4 strokes with a 4 under 68 in the final round. Tiger Woods' score was his worst ever. And that's your Bloomberg Brief, John.
I think the fact that Tiger made the cut was pretty phenomenal, given he's hardly played over the last 12, 18 months. Danny, thank you. Up next on the programme, Iran's unprecedented attack on Israel.
It's a new Middle East. It's a Middle East in which Israel every day must wonder if some action might provoke an Iranian missile attack or drone attack on Israel's territory directly.
The latest on that story. We'll catch up with Bloomberg's Nick Wadhams down in Washington, D.C. And from the White House, John Kirby, the National Security Council coordinator. All of that coming up next. Equities on the S&P 500 positive here by 0.5%. 0.6%. Just a brief bounce, a little one, following last week's losses. Going into US retail sales 14 minutes away. The cash opened 60 minutes after that. Yields higher by 6 basis points on a 10-year, 458, and crude lower by almost 0.9% at 84.92. Under surveillance this morning, Iran's unprecedented attack on Israel.
It's a new Middle East. It's a Middle East in which Israel every day must wonder if some action might provoke an Iranian missile attack or drone attack on Israel's territory direct. And it also is a new Middle East in which Israel is now, in theory, open to do the same against Iran by allowing Iran to conduct an unprecedented attack, which was certainly not just symbolic. You now have this new world.
Here's the latest this morning. President Biden and G7 leaders urging calm after Iran's first ever direct attack on Israel. According to reports, Biden speaking to Israeli Prime Minister Netanyahu over the weekend saying, take the win and slow things down. Reports also saying Biden told Netanyahu that the US will not support a counterattack against Iran. Bloomberg's Nick Wadhams joins us now for more. Nick, what don't we know based on the attacks over the weekend that you'd like to know right now?
Well, the big question for me is twofold. One is obviously what will the Israeli response be? The messaging we're hearing from the region is that revenge is a dish best served cold, suggesting that they may wait some time to respond, though it does seem like a response at this point is a certainty. The other question for me is what leverage does President Biden actually have to shape outcomes here? As you mentioned, the U.S. has been very clear. It thinks Israel should take the win and not respond. But there's going to be a lot of pressure being put on Prime Minister Benjamin Netanyahu. On the other hand, he said he's determined to go ahead. So we're really going to see the limits of U.S. influence on Israel in the weeks ahead.
Does this mean, Nick, that there's no longer a red line? Have they just completely evaporated?
Well, that's a great question. Another thing we're trying to figure out. I mean, obviously, this does change the equation significantly when you have Iran launching a direct attack on Israel. I mean, the issue is that this proxy war has been going on for so long. Israel has taken pretty aggressive strikes against Iranian officials and taken out Iranian nuclear scientists on Iranian territory before. So there's a lot that's happened that seems pretty explicit, but just has never been acknowledged. Now that this is just so blatant and so out in the open, you would think that in some ways Israel, or at least they're saying they may feel compelled or provoked to respond. But certainly we're in a moment where it feels like all the bets are off. All the sort of guidelines and rules of the road, such as they are in a conflict like this, have now been shed and put aside.
Nick, we'll do our best to get you some answers. Nick Wadham there of Bloomberg down in Washington, D.C. Joining us now is the National Security Council Coordinator, John Kirby. Admiral Kirby, fantastic to catch up with you, sir. Busy weekend, I'm sure, for you and the administration. Let's get straight into it. We've heard from Iran, at least they've indicated the matter can be deemed concluded. I think we all want to know, Admiral Kirby, whether Israel has indicated the same thing.
I won't speak for the Israelis. I think you can understand that. I believe the War Cabinet is still deliberating and making their decisions. The President had a very good conversation with the Prime Minister right after or towards the end of the attacks on Saturday night. And the President was very direct that this was a huge success, that Israel can be proud that it doesn't stand alone and that it has superior military capability. Iran utterly failed in what they were trying to achieve, and that success alone sends a strong message to Iran and to the region about Israel's place there.
Sir, could we just define success? How can we define the weekend's events as a success, to see the first direct strikes coming from Iranian soil on Israel? How is that a success in any way, shape or form?
Yeah, let's talk about what didn't happen. Hardly any damage, and the only impacts were to an air base in central Israel. No real casualties except, sadly, a young civilian girl was critically injured. And the vast majority, as the IDF have said, 99% of what Iran threw up in the air, drones and missiles, never landed. Either failed or actually got shot down. So that's what didn't happen. And what did happen was Israel proved it has superior military capability, and just as critically, they don't stand alone, that the United States stands with them. I think people are maybe not cognizant of the fact that the president put U.S. forces in harm's way to help defend Israel. For the first time, American fighter pilots in the air shooting things down that were heading towards Israel. And they were extraordinarily successful in doing so. I think that's significant.
You're talking about a successful defense. I think a lot of people also focused on the unsuccessful deterrence. The president said don't, and they did. And we're trying to work out, Admiral Kirby, in what way the U.S. is able to influence Iranian behavior.
Well, the president pre-positioned military forces in the region, which allowed for that unprecedented successful defense. The president met with the G7 leaders yesterday to talk about a unified diplomatic response and to consider other options and alternatives to try to hold Iran accountable for what it did on Saturday night. Iran is increasingly isolated in the world, certainly in the region, and Israel has proven that it has friends.
If Israel does not respond, is the new status quo that Iran can strike Israel from its own soil and there won't be a retaliation?
Again, I can't speak to that, Annmarie. That's going to be up to the Prime Minister and the War Cabinet to make those decisions. We respect that it's a sovereign nation and they have to make those decisions.
There's lots of reporting that the Biden administration that was verbalizing to the Israelis that they do not support a counterstrike. Isn't that, in a sense, taking one of those tools out of the toolbox and brandishing it to the world?
The tools that we took out of the toolbox were pretty significant on Saturday night, Annmarie. Ballistic missile destroyers in the Eastern Med helping shoot down ballistic missiles, fighter aircraft in the air, other partners participating. There was a lot of tools in the toolbox, and that there's no question that Iran recognizes the coalition that was put together to help Israel defend itself. Again, I can't speak for what either side will do going forward. All I can do is speak for President Biden as Commander-in-Chief. He has since October 7th, and he will continue going forward, making sure that we are meeting our commitments to Israel, but just as critically that we're meeting our commitments to our own national security interests in the region, making sure we have the resources in place to protect our troops, our facilities, and the missions that we're conducting there in the Middle East.
We've had 60 tons of arsenal fired upon Israel directly from Iran. We've had 6 months of Iranian-backed Houthis hitting as well, trying to hit even U.S. vessels in the Red Sea and disrupting global trade. We also had an uptick of uranium enrichment by Iran. So to get to this deterrence, what is the U.S. willing to do? We have sanctions in place. Is the United States willing to enforce them?
We have been enforcing sanctions. I mean, my goodness, in the 3.5 years of this administration, we have implemented more than 50 sanction regimes targeting more than 500 entities and individuals. And again, I won't preview coming sanctions or anything like that, but I can tell you that additional sanctions are certainly not off the table in terms of holding Iran accountable. And take a look at the additional military resources that President Biden has added to the region, even before October 7th. This is something that he's been keenly focused on. And as we saw from Saturday night, Iran is increasingly isolated on the world stage. They are increasingly making it harder for anybody in the international community to be sympathetic to any of their inimical interests there. So, again, I think we've done a lot. We'll continue to look at our options going forward, and I suspect that we'll continue to hold Iran properly accountable.
Admiral Kirby, how are they isolated? They had a call with the Saudis. They're sending all their oil to China. They're sending Shahed drones to Russia. In March, Iranian oil output hit a 5-year high. Where is the enforcement?
There is enforcement of the sanctions, Annmarie. Again, this is one of the most heavily sanctioned countries in the world. And we're going to continue to look at our options going forward to hold them properly accountable. The sanctions are certainly not off the table. Neither is going to making sure that we've got the capabilities in the region, and we do, to thwart some of their destabilizing activity. You talked about the uranium enrichment. When the previous administration pulled out of the Iran deal, it vastly accelerated the degree to which Iran could start to spin up their centrifuges and get closer to some sort of breakout capability. The president obviously tried. We tried, but Iran was not negotiating in good faith to get back into that Iran deal. But he also made clear that we will not allow Iran to achieve a nuclear weapons capability. We prefer to do that through diplomacy. But if not, we've got other options available to us.
What's diplomacy? Bob Malley, the Iranian envoy, is still under investigation. Who is leading these diplomatic efforts?
As I said, the diplomatic efforts to get them back into the Iran deal are no longer being pursued because Iran wasn't negotiating in good faith, which is why we're going to make sure we have other options available to us to prevent them from achieving a nuclear weapons capability.
Admiral, one question, and Annmarie did touch on this question around what the response could be to Iran seizing a vessel in the Straits of Hormuz, the idea of freedom of the seas. What's the U.S.'s response to that, given the fact that a lot of companies have already started to rejigger some of their trade routes and bake in extra costs as a result?
Yeah, I had a little trouble hearing you over the lawnmower there, but I think I got the gist of the question. We certainly condemn this most recent maritime attack. This is a tactic that the Iranians have used in the past. We have, when able, been able to interdict, been able to try to thwart other such maritime attacks, not all of them, of course. And we are also making a concerted effort over time, and we have been somewhat successful in intercepting goods that the Iranians have been trying to ship by sea to some of their proxies in Iraq and Syria, and certainly the Houthis.
Admiral, one thing that a lot of companies are saying, and a lot of executives, is that they do have to make contingency plans because they aren't sure that there can be such safety, and you've seen insurance costs go up. Is it appropriate for the U.S., for Israel, to more directly respond to Iran at some point, just not now?
Again, I can't speculate about future operations one way or another, or future decisions that we might have to make. The president has been clear. We're going to hold Iran accountable for their destabilizing activities. He's also been clear that we don't want a war with Iran. We're not looking for another war in the Middle East, or to see the conflict that's currently underway in Gaza broadened or deepened across the region. Now, we'll have to see how things unfold over the next coming days here. But we don't want a war with Iran, and everything the president has been doing since the 7th of October has been designed to try to bring the tensions down and to make sure that the United States is best postured to defend our interests there in the region.
You're in a fight now with a lawnmower, sir, so we're going to let you go. National Security Council Communications Advisor John Kirby. John, thank you, sir. Admiral Kirby, we appreciate your time. Far too disruptive for John to even hear us at this point, at the end of that conversation. But some serious points. How they defined success over the weekend. I think there will be a camp that won't define that as success. If you view success as successful defense, success. Limited damage, no casualties. If you define success through deterrence, it's very, very difficult to do that based on how this has escalated over the last few months.
There has not been deterrence when it comes not just to what happened in terms of the more than 300 missiles and drones fired from Israeli soil, Iranian soil to Israel, but also what's been going on in the Red Sea for the past 6 months. Wall Street Journal editorial board this morning says White House theories of escalation management don't work against a regime that thinks a U.S. president fears escalation more than Iran does. How many times have we heard Admiral Kirby say, we do not want war, we do not want escalation? Some say you have to actually put that on the table to not get that war.
I think, as Norman Rule said, the former senior U.S. intelligence official, a little bit early this morning as we started this program, whatever you think about the weekend's events, we have a new Middle East. If you are just joining us, welcome to the programme. Equity futures on the S&P 500 positive by 0.6%. The scores look like this. Going into US retail sales, a little bit of a bounce here in the equity market. We're up by 0.7% on the Nasdaq 100, following the biggest one-week loss on the S&P going back to late October. Late October is when this equity market rally, this big move higher, started. In the bond market, yields higher through last week by double digits. The 2-year breaching briefly 5%. This morning, up by 6 basis points, 495.46 on a 10-year at the moment, up 6 basis points to 458.30. And just to round things out for you, if we can check in on foreign exchange going into this print on US retail sales, the euro at the moment 106.46. Here's the data for you. So far so good. It's an upside surprise. Retail sales advanced month-on-month read coming in at 0.7%. The estimate was 0.4. You strip out autos and gas, we come at 1%. The estimate was 0.3. And if you're looking for the retail sales control group, the input into US GDP, that is a big upside surprise as well at 1.1% against an estimate of 0.4. The price action off the back of it looks a little something like this, just about holding on to the gains of the equity market of 0.5% on the S&P 500. But in the bond market, we're shooting higher again on a 2-year higher by 9 basis points, just below 5 percentage points, just below 5% at 4.99. On a 10-year up by 9 basis points, taking out 460 all over again. 461.58. Lisa, that is a hotter than expected U.S. retail sales report.
And the revisions from the prior month are all upside revisions. So if you're looking for some sort of dampening effect, you don't get it. It goes to what Cameron Dawson is saying, which is if you see a strong retail sales number, that really confirms the strong employment numbers that we're getting, because it's not an anomaly. People have jobs. They're spending regardless of some of the inflation.
Retail sales coming in hotter than expected. Yields are up and equities are just about holding on. The 2-year at 4.99, the 10-year at 4.62. Joining us now, I'm pleased to say, is Bloomberg's Michael McKee, sitting down for an exclusive conversation with the New York Fed President, John Williams. Mike McKee, it's over to you.
Good morning, everybody, and we'd like to thank John Williams for joining us on Bloomberg Radio and Television Worldwide. John, numbers just came out. Pretty amazing. Are you continually surprised by the American consumer?
Well, first of all, welcome to the New York Fed. We're celebrating the 100th anniversary of this building here on Liberty Street. The consumer spending has been strong. I think it is driven by strong fundamentals. Job growth has been solid. We've seen real wage gains. We're in a pretty strong economy with good growth. So, yes, it's part of that story. But, I think what we're realizing is we're getting a nice tailwind from the supply side of the economy. Good labor force growth, strong productivity, good real wage gains. So with that, I think, consumers are spending.
What's the thinking in your office and among your colleagues about, does this last? Or is this a surprise that you think could go away at any minute?
Well, one thing that makes it really hard to forecast is we're still feeling the effects of the after effects of the pandemic and Russia's war in Ukraine and all the things that have happened in between. So we're definitely still seeing an adjustment process by the consumer, in the economy overall. But overall, I think that the economy will continue to grow at a solid rate this year, probably not as high as the 3.1% we saw last year, but something like 2% or around that. So I feel like we're still in a good place, probably not as rapid a growth as we saw last year.
Speaking of international events, I have to ask you, the Middle East going on right now, how do you think about the economic and policy implications of these events?
Right. So obviously we're watching this very carefully. I think the primary way you see it through now is, first of all, through commodity prices, but second is what we think of as a flight to safety, where investors, when they see risks in the global economy, they tend to bring money to the U.S. dollar, and that tends to push yields down somewhat. Right now, I think markets are pretty stable. We're not seeing big movements in that way, but generally that's the way what I would expect to see when you see heightened geopolitical tensions.
When you think about what the markets are reacting to and what could come out of this, is this more of an inflation worry or a growth concern?
Well, it's really hard to say. It really depends on how the situation evolves. Right now, I don't think of this as, maybe in the near term, it could be effect of financial conditions and commodity prices, as I mentioned. I don't see this as a major driver of the overall forecast or outlook for economic growth or for inflation.
Speaking of inflation, CPI came in much hotter than expected and sort of freaked everybody out on Wall Street. And markets sort of took that as a turning point in Fed policy. Do you see it that way?
I don't see it as a turning point. I think that, we saw inflation come down maybe quicker than we expected last year. We definitely saw really lower readings in inflation in the final 6 months. That I never thought that was going to stay that low. That was kind of unusually low. We're now seeing some a little bit unusually high readings. Overall, I think the picture is one of that the economy is getting in better balance. We still have a strong labor market, and we're seeing inflation gradually come down. Now, I do think that, for me, what do I see in the data? Well, the economy, and you pointed out the, retail sales today, but more broadly, the economy continues to be strong. Again, I think we're being helped by strong demand and supply, and those are helping, growth. And we're seeing, inflation come down a little bit slower than expected. And so, I think markets are taking all of that information into account and how they expect policy to be. For me, I'm, data dependent as always. Really take the totality of the data and think about what it means for achieving our maximum employment and price stability goals. So I don't see this as a game changer or anything. I do think it's important information that will clearly, affect my thinking and my forecasts.
Even those who've thought about what PCE might be after the PPI and CPI say inflation isn't coming down rapidly anymore. But you do have the strong growth. You have very low unemployment. Why cut rates if the economy is doing fine at this level?
Well, first of all, I think monetary policy is working at the rates that we have now. So I think monetary policy is in a good place. Over the past 12 to 18 months, we've seen pretty much all the measures of imbalances in the labor market and our economy recede, many of them back to levels we saw in 2018 or 2019. So we're seeing restoring balance in the economy. We are seeing a slow decline in inflation. So I do think monetary policy right now is in a good place. I'm not fixated on where do rates need to go, over the next year. What I'm focused on is how do we best achieve our maximum employment and price stability goals. The data we're seeing show that the economy is strong, and that's really good news, and labor market is strong. At the same time, we are getting better balance, and we're seeing some decline overall in inflation. So for me, it's really about getting that right, and then whatever we need to do to adjust monetary policy, we can do to best continue the progress towards our goals. So that's how I'm thinking about it, and we'll just have to keep watching the data and make the decisions based on those goals.
Well, is your base case that you will cut rates this year?
My own view is I think that with inflation continuing to gradually come down, and I guess I would say gradually is the operative word here, and with the economy remaining strong, I do think that given where the level of rates are, real interest rates now are considerably higher than they were before because inflation has come down quite a bit. So we will need to start a process at some point to bring interest rates back to more normal levels. And my own view is that that process will likely start this year. But again, it's going to be driven by the data and achieving our goals.
So it's possible you don't do anything this year.
Well, again, you're asking me to speculate on what will happen over the next 8 months. Of
course.
And right now, I think monetary policy is in a good place. We're seeing the progress. We're seeing progress. It's a bumpy road on the inflation front, and we'll just have to figure out how to best adjust policy as needed to achieve our goals.
Well, you mentioned the real rate. Is policy tight now?
I do think we have restrictive monetary policy. I do think policy is tight. So what do I look for? Because the economy is growing. It grew over 3%. We're adding about 275,000 jobs over the first 3 months. So that seems like an economy that's really strong and not being held back by monetary policy. But if you take a step back, all these measures of imbalances in the labor market, whether job openings or wage rates or quits rates or all the other indicators we look at, all of them are moving from being very tight to less tight, and most of them back to more strong labor market or getting closer there. I mean, job openings are still high, wage growth is still a bit high, but these are all moving in the right direction. So I think the stance of monetary policy has really been an important driver of restoring balance to the economy and helping bring inflation to 2%, towards 2%.
What's left with inflation? Is it something that you can affect, or are these non-interest rate responsive sectors?
Monetary policy can affect inflation in the economy. It works through multiple channels. So there are some sectors that maybe are not as interest sensitive, but the economy is interest rate sensitive. We've seen that over the past couple of years as we've moved from a accommodative policy to a restrictive policy. So monetary policy is working. I expect it to continue to work to bring inflation down. You're going to see it show up in different parts of the inflation rates, goods versus services and things. But over the past year and a half, we have seen a broad-based decline in inflation in all of these categories. It's just that we haven't gotten all the way to 2%, and we just need to keep policy in the right place to achieve that 2% goal.
Question I always ask is, what are CEOs, companies telling you these days about their hiring plans, about what they're having to pay, and about inflation, whether they're raising prices or having to pay higher prices?
Well, clearly, if you asked me this question a year or two ago, that's all they would be talking about. Price increases, compensation increases, the challenges of hiring employees. Today, I think those comments are still out there a little bit, but far less than before. We're hearing from our contacts, that it's easier to fill positions than it used to be. Wage compensation pressures are less, and price pressures are less. I think that's consistent with what we're seeing overall in the data.
You're the potential growth guy. Has potential growth moved up?
I am getting more optimistic about potential growth in the economy, I think for a couple of reasons. One is, through the pandemic and everything that happened after that, I, like most people, had concerns that the supply side of the economy had suffered, damage, the labor force in terms of labor force and participation. And as we've watched the data over the past 2 years, we've seen a increase in labor force participation, increase in labor force growth, and we've seen a rebound in productivity. Now, I'm not saying that we're in some new high growth kind of a world, but I do think potential growth is probably closer to 2% or a little higher, which is well above a lot of estimates of the past few years. And that's a very positive sign for U.S. real incomes and for the economy, and honestly, for helping get inflation down.
A question for all of our friends around us on trading desks. You had a briefing on QT at the last meeting from the Fed staff, and members, according to the minutes, generally agreed that it should start soon. Does that mean May or does that mean June?
Well, I think we said fairly soon, and I think that the reasoning for slowing the pace of reduction of our balance sheet makes a lot of sense. It's a prudent course of action. We are decreasing the balance sheet quite rapidly, and by slowing that, we'll have more ability to monitor, assess, and analyze as we get eventually to an ample reserves kind of world that we're aiming for. Everything is going with the balance sheet. Everything is going exactly as planned. Things are going well. When we decide to, slow the pace of the balance sheet, that's a decision for the committee. No decision was made at the last meeting, but obviously we'll get together relatively soon and discuss this further. But to me, this is a sign of success of the plans we laid out almost 2 years ago to reduce the balance sheet. We've had very little disruption in markets. It's worked exactly as planned, and we're just executing on that plan, and that's going very smoothly.
So QT could come before rate moves.
Yeah, these are really separate issues. I mean, on our shrinking the balance sheet, we're focused on getting to ample reserves. On monetary policy, we're very focused on achieving our maximum employment and price stability goals. Those are different objectives. Those instruments can obviously move at different times in different ways.
John Williams, thank you very much, President of the New York Federal Reserve. We'll send it back up to you.
Mike McKee, an absolutely brilliant exchange. Thank you, sir. Appreciate it. Mike McKee sitting with one of the top three on the FOMC following a hot retail sales report. Now, here's the thing with exchanges like that. Sometimes in an attempt to say nothing, you say something. And that something is this. I think monetary policy is in a good place. I do think monetary policy is tight. That's meaningful, given the fact that we've just had three so-called bumps in the road on inflation. And that conversation follows a hot retail sales print in America and a repricing of the bond market again that looks a little something like this. And we can roll through the markets board for you. And we can start with fixed income. Big readjustment in Treasury yields, up 7 basis points to 496. On a 10-year, up 8 basis points to 459.94. Lisa, conversations we've had ever since we got that hot print last week. Are we restrictive enough? Are we sufficiently restrictive? And what you hear from a senior official at the Federal Reserve is they believe monetary policy is still tight, even with this data.
And they are willing to wait and watch the data. The idea of I'm not overly concerned about where rates are going, well, the rest of Wall Street is, and have been trying to game it out pretty extensively. The question is, how much do they start to look at this data and say it prevents them from cutting rates again? He didn't answer that question directly. He hemmed and he hawed and he tried to move around it. But the implication was, nothing really has changed. He said that point blank. That data point last week did not change our view, and neither does his retail sales. What will it take then, given the fact that the rest of Wall Street seems to be thinking something's shifted?
It'll change things for other people, let me tell you that, particularly maybe at the BOJ. We took out 154 on dollar yen just moments ago following that hot retail sales print. Yields up for the right reasons, I will say. Retail sales coming in hot. Equities holding on. We're up by 0.75% on the S&P 500. The opening bell, 45 minutes away. Coming up very shortly, we'll catch up with Tom Porcelli of PGIM, reacting to an upside surprise for retail sales. And we'll get into those comments with New York Fed President John Williams. All of that coming up next from New York. This is Bloomberg. Fairly interesting 20 minutes. Let's get to the market for you. Retail sales coming in hot. Equities look like this, holding on. Positive by 0.75% on the S&P 500, even as bond yields readjust again. Up 8 basis points on a 10-year, staking out 460. Up 7 on a 2-year, getting closer and closer again to 5%. In foreign exchange, it means a stronger dollar against the euro, 106.40. Bramo, dollar yen, taking out 154.
Honestly, we were talking about the red line, which was 152, and that quickly got blown up by the idea of hotter prints than usual in the United States. This goes to the question of divergence. How far can other central banks diverge from the Federal Reserve when the currency channel is getting increasingly challenged? And that's what we're seeing in the market today.
Retail sales in America coming in at 1.1%. The estimate positive 0.4%. That's the right kind of upside surprise. Under surveillance this morning, the view remains the same. Here's the latest. President John Williams not changing expectations following a hot retail sales print and not changing his view on inflation, eventually coming down. PGIM's Tom Porcelli joins us now for more. Tom, I'd love your thoughts on this. Let's get into these comments from John Williams off the back of that retail sales data, that print just moments ago. Monetary policy's in a good place. Monetary policy's tight. Do you agree?
Yeah, I mean, look, I think it's been really interesting, right? We've had this string of really strong data, yet the Fed doesn't really seem to be changing their tone all that much as it relates to cuts. I mean, some people are pushing cuts out, but they still seem to want to cut. I mean, John Williams literally just said those words. I mean, I sort of cherry-picked one of his comments. He said, so we'll need to start the process at some point of normalizing policy. And my own view is that likely starts this year. I mean, that was his exact quote. I think that this is a Fed that wants to really push ahead. I think it's become incredibly challenging to do it in the very near term. I think we should talk about that. But I think this is a Fed that clearly has a view that they want to cut, and I think they're going to.
Let's get to that comment that you picked up on, though, Tom. I do think it's important. Yeah. We need to start the process at some point. Says who?
Yeah. So, says them, and says they're the way that they view how restrictive policy is. I mean, I think that, there's 10 officials who think that, they should cut 3 times this year, or at least that was the case before CPI. And they're clearly sort of arriving at the conclusion because they think monetary policy is rather restrictive. Now, look, our own view is that if you look at their long-run estimate, we think the long-run estimate is way low. We think it's actually going to come up pretty meaningfully. And in fact, we would argue that it probably should have come up pretty meaningfully already. But I think, you have folks like, President Williams, who believe that policy is restrictive enough for them to really want to start the process of cutting.
What struck me was he also said, I'm not overly concerned about where rates are going. This kind of speaks to the terminal rate, kind of where we're going to end out. It's sort of unique that the Fed is not worried about that. Everyone else is. Why is it important to worry about that?
Yeah, I mean, look, because it goes to exactly this idea that we were just talking about. It's how restrictive are you going to be? And I think you could easily make the argument that, if you look at sort of nominal long-run rates, they probably should be closer to 3.5%, not closer to 2.5% that the Fed is pinning in their SEP. And so I think it's sort of nice to say we're not really so worried about what's going to happen down the road, but the market is. I mean, 10-year yields at the end of the day are supposed to be a reflection of what you think Fed funds will average over 10 years. And so the market is trying to figure that out. And this is an idea that, Lisa, you and I have talked about over the months. It's like the market is still very much in price discovery mode. I mean, I look at 10-year yields at 4.6% right now. And the move that we've seen over the course of the last week or so, I mean, the market is trying to gauge where this is going to shake out. Again, I would argue that, if you wanted to put a pin in a number, 450 probably seems about right on 10s. Again, you have to draw a circle around that. But I mean, just as a starting point for the conversation. And I think that, to me, is a really instructive way of framing President Williams' comments.
One thing he also said is just to take each data point as it comes. And we've seen a number of hot data points. Do you think that this is sort of a flawed process? We've talked about this with Mohamed El-Arian, that the idea of coming without a thesis and just coming from backward-looking data points and trying to push them forward when we're going to revise them later anyway could be problematic. Do you agree?
I do. I think data dependency, the way that we've defined data dependency, which is to say, sort of allowing the market and even Fed officials to shift their views on every single data point. I don't think that's the right way of crafting monetary policy because I think it lends itself to a lot of volatility. I mean, I think about that CPI report. And again, make no mistake, I get it. The Fed's not cutting in June anymore. But I think it's worth, sort of understanding, well, what really did a lot of the damage within that CPI report? And there were two things that the Fed really can't control within that. One was auto insurance and the other was healthcare, which I think is sort of well-worn idea at this point. If you're going to be hanging your hat on every singular data point, then I think you do have to go through the process of dissecting every single data point to make sure that the reason it rose is sort of a legitimate reason and something that policy can affect. And I would argue that the reason CPI rose is not something policy can alter.
The other thing that policy can't alter is commodity prices, and we've been grappling with this. How is the Fed going to respond if we get a spike in oil prices, but also just more broadly a structural bid to the commodity sector? Should we be thinking about it, though, in more of a long-term story, just simply because of all the infrastructure spend and all of the different features that are really going to give a bid into the precious metals and beyond?
Yeah, Lisa, I think the way that the Fed will think about that is, the sort of through the classic channel for them. They're going to think about it through the lens of inflation expectations. You get a lift in commodity prices. How does that alter people's perceptions of inflation through the expectations channel? And so if you start to see inflation expectations start to drift, and in fairness, they really haven't. But if you start to see them drift, I think that's what the Fed will wind up responding to in the end.
Hey, Tom, this was great. I just want to finish with one final question. I know you're in a different seat now, but I do want your best guess. We saw some big revisions last week. Mike Gape, Bank of America, June out to December. Matt Lazzetti now saying December as well. Where are you at now, Tom?
Yeah, look, I think that to get July, I've become almost bimodal in some way. I almost feel like you're either getting zero or you're getting a lot of cuts. I think July is going to be very complicated. You have to get this string of really sort of, palatable inflation reports between now and then, and you get 3 between now and the July meeting. So I think July is certainly on the table. But if you don't get July, they're not going in September, and they're not going in November. I know the Fed likes to say, well, hey, look, we've adjusted policy around elections. Yeah, but they've only done that when policy has unquestionably needed an adjustment. If it's a debatable point, they're not going to be able to go. So if you don't go in September and in November, so if you don't go in July, then I think it leaks all the way out to December. So I think at best the Fed gets 1 in this year, maybe 2. But I think the calendar is sort of working against them.
Interesting. Tom, thank you, sir. Tom Porcelli there of PGIM. Heard that a few times in the last week. The last pre-election option on the window, the last window on the calendar is July. And then once you go past July, you start creeping towards December.
Which is the reason why we've seen so many people push back. Who was it, again, who came on this show and basically was talking about December? And we all said, you're crazy. No way.
Stephen Stanley talked about it a bit, yeah.
Exactly right. And he seems to be on a page that everyone seems to be coming toward. Remember how crazy we thought he was at the time? Not crazy. We didn't think you were crazy. But it was a bold call.
Not crazy like mental, but sort of out there.
Not this kind of crazy.
Not
just
Bramo
sort of,
crazy.
just sort of general kind of,
Not
bold.
That crazy. No, but some interesting calls out there at the moment. I think we're all on the same page for this. At the moment, you look at global growth, front and centre, US exceptionalism. We saw that a lot coming into this week. You see it again on the screen looking at retail sales, the US versus the rest of the world. The man who wrote the article on that in the last week is going to join us tomorrow morning. Mohammed Al-Aaron of Queen's College, Cambridge, alongside PGIM CEO David Hunt. Fantastic lineup for you. Whaley of BlackRock, Torsten Slock of Apollo, who said it now for a few months. No rate cuts in 2024. That conversation coming up tomorrow morning. Your opening bell 34 minutes away. Equities looking okay. We're positive 0.75% from New York. This was Bloomberg Surveillance.